What is going on, guys? It's Tempo Trades. I just want to start off by saying thank you for accessing the free course. I'm happy that you're trying to become profitable, and it is my mission to help you get there and be a small part of your journey. So in this video, it's going to be the introduction video. There's not going to be any editing. It's just going to be just me and you just having a casual conversation. And I just want to kind of explain my roots and where I'm coming from, and maybe you can relate to that. So I came from an e-commerce background. I made money online before trading, and I always knew about trading. You know, with e-commerce, it was good, the money was good, but the work-life balance was not good. You would work 8 to 12-hour days. There was no breaks. And I always saw trading as like a plan B, you know, because I saw trading and I'm like, it was interesting because trading has a cutoff. You know, every single day the market cuts off at 4 p.m. So when I was trying to get into trading, I was like, you know what, that's interesting. You know, if my e-commerce stuff dies down or I get tired of it, like I want to try this. You can make the same amount of money, if not more, you know, and the work-life balance just seems really, really good. So at the end of 2021, start of 2022, I started trading, and it was a roller coaster, man. Like maybe a lot of you guys watching this video, I lost a lot of money my first year, as many people do. And I was just learning lessons, you know, I was learning lessons. I was trying to figure out what strategy I was going to trade. I was trying to figure out my psychology and just so many things. And that's why I'm trying to help you guys with this course. If you can watch this course, I'm not charging you a dime. It's not like people out there that they're going to charge you 4, 5, 6,000 for this information. I've been there. I've been exactly in your shoes. And I want to help you get to where I'm at now. So yeah, just to go back to the story. So I started trading options. I can even show you right here if I just turn on my screen. I started trading options and it was not fun, man. It was not fun. As you can see, I pretty much lost close to $30,000 trading options my first year. The good part is, and this was of my own money too. I didn't even know what prop firms were. I was just trading my own money. I think I deposited like $80,000 from my e-commerce money, and I just threw myself into options. And that was very, very stupid, because if I used prop firms, or I knew what prop firms were, or I understood that I'm probably not going to be profitable my first year, I could have saved myself a lot more money. But I was stubborn. I sat there to myself and I was like, hey, you know, I've been successful in this other area in my life. Surely I can make this work if I just keep brute forcing my way through. And that's something we'll talk about later when we talk about psychology. But I was not profitable in my first year, and it was very frustrating. It was very sad as well. A lot of sleepless nights just sitting there and being like, wow, like at some point, am I going to have to hang it up? Am I going to have to go back to e-commerce and be unhappy with those 8 to 12-hour work days? But I'm very, very happy that I managed to keep going, because just 12, 13 months later, I started making real money from prop firms. I have so many payouts that I can't even show you them all, but I've now made over $500,000 as of recording this video just from trading by itself. And I do post most of my payouts online on Twitter. So I've gotten payouts on many different prop firms: My Funded Futures, Take Profit Trader, Top Step, you name it. So I know what I'm doing. I've been through the ringer, man. I've been through the absolute ringer. I've seen the lowest of lows, and I've seen the highest of highs. So believe me when I say that I know what I'm talking about, and I want to help you. So that's just a little bit about me. You know, once I became profitable, 12, 13 months into my journey, I started, you know, going from losing money every month to now actually, I just want to put this full screen. So I started losing money every month at the start, and then 12, 13 months in, I was, you know, just like anyone else, I was flip-flopping strategies, and I started going from losing to actually breaking even. And then some months I'd even make a little bit of money, and I'm like, oh wow, like this shift is crazy, like this feels really good, you know. And then I found IFVGs, right? And I just saw within a few months of that, 2-3 months of IFVGs, I saw a huge exponential growth, you know, 5K a month, then 10K a month, then I was doing 30K a month, and now eventually to where I'm at now. And yeah, it was a gradual thing. It didn't happen overnight. A lot of people expect it to be instant, which is what we'll talk about in a future video, but it was a grind, man. It was a grind. And now once I became profitable, I was just like, look, I've been through so many discords, trust me guys. I was just like you. I've been through 10 different discords. You know, some of them were good in this way, but some of them sucked in this way, and some of them didn't answer your questions, and some of them did this. And like, it was frustrating for me because I really could never find the perfect community. Like, some communities had really good things about it, but not others. And I just told myself, look, if I can never get consistent enough to do this full time, I'd really like to make the community that I wish I had when I was trying to become profitable. And I think that's what we've done here. We've been streaming live for the past 16, 17 months, and we've done some absolutely incredible things, man. We've done some absolutely incredible things. If I just show my screen again, we've helped countless people get payouts. If you just look through my testimonial channel, even as big as $30,000. I mean, one of our students made 30 grand in a payout. So it's very humbling. It's just very gratifying. And I would like to help you do the same. So keep watching this video. This is just a quick introduction about me and my journey and how I even got here and who I am. So I am currently a profitable day trader. I trade live every single morning with my community. But it wasn't always that way. It wasn't always that way. And I'm hoping that after watching this video, you yourself can become profitable as well. All right. So let's click on the next video and I'll see you next time. All right, guys, in this video, we are going to be talking about expectations and misconceptions. So this is going to be very, very important because your expectations should be normal going into trading. Okay. A lot of people quit trading within just a couple months because they see these people on social media flexing all this money and payouts and the cars and all the things you see. And they think that, oh, wow, and me included, when I was starting, I was like, oh, wow, you know, if I could just copy this guy or follow this guy, and within a couple of months, I could be cash flowing, you know, 10K extra a month. It's like, no, that's really not how it works. And it took me a lot of painful lessons to understand that. So we're going to be going over a couple of points just so before even getting into the nitty gritty of this course, you can properly have your expectations outlined. And I will give you some tips, and from what I've seen is also my experiences. So the first thing is, how long will it take to become profitable or see any money in general? And the simple question is, it depends on you. I would say trading is very hard. Obviously, I'm not here to tell you that trading is easy. If trading was easy, everybody would do it. Nobody would work a traditional 9-to-5. Trading, though, is the best job in the world, in my opinion. It allows you to make insane amounts of money while being your own boss, while having the financial and location freedom to go wherever you want, whenever you want, and trade from wherever you want. And it can just open up endless possibilities for you. So I think it's the best job in the world. And that's why all the grind, all of the grit, everything is worth it, in my opinion. Because if you can reach the top and hit that point, it's amazing. It's amazing what life can be. So how long it could take to be profitable, it's up to you. I mean, for me, it took 12 to 13 months. I know a lot of people, they say 2 to 3 years. But I've seen as quickly as 3 to 4 months. I personally taught my cousin, shout out to him, I taught my cousin how to trade ICT. He's a college student. He had a lot of free time. I showed him my first free course. I showed him a couple YouTube videos, and he got a payout with Top Step within 3 months, you know? So it really just depends on you. It really just depends on you, and you need to just have a realistic expectation about it, because a very small percentage of people are able to make it and be consistently profitable, and an even smaller percentage are consistently profitable in their first year. So for me, if I had to redo it and do it all over again, I would just treat my first year as tuition. You know, just like you go to college, you pay a 4-year tuition. That is the tuition you pay the college to give you information to be able to have a job to make money. It's the same exact thing. You know, if I'm starting, I have no expectations my first year. If I make money, great. If not, all of the lessons, what I am paying for is all of the lessons I've learned the first year, and that will eventually pay off in those later years when I do become profitable. That would be my mindset going into this thing. Because again, if you expect like, oh man, I'm gonna start making money within 2 to 3 months, no matter what, it's going to hurt your psychology. It's going to hurt your psychology, and it might even make you quit when you face some adversity. So that's number one. Number two, how much money can I make? Again, this depends on you. So I would say it is very, very realistic to make $10,000 a month with trading. I showed you in the previous example, there's 50 to 100 cases in my community where people have made $10,000 or more a month off prop firms and trading. So it is very, very realistic. But at the same time, it's like, how much money do you want to make? You know, you can trade one account with not so much leverage and just make a couple thousand if that's what you want. If you just want no stress, you just want to pay your bills, have some extra side income, that you can do that. If you want to go super high leverage eventually and try to make 50,000 in a month, you can do that as well. And based on what your goals are, you need to correctly align yourself with your approach, is what I would say. Obviously at the start, you don't want to just aim for the moon and try to make 50K a month. I would say it needs to be gradual, right? First, you want to just try to have a profitable month. Then you want to try to have a profitable month 3 months in a row. Then you might want to have a $10,000 month. Then you might want to have, and then, you know, you're slowly building and progressing versus, okay, month one, I made 5,000. Now month two, let me make 50,000. Like it's not going to work. The psychology thing, again, it's not going to work. So just align your expectations before going in. What are your goals? You know, do you want to do this full time? If so, how much money realistically would you have to make a month? You know, do you only want to do this to pay your bills and some side cash? Okay, that's what you want to do. You really need to polarize that in your mind before you get into it. Okay. Now, number three, how much, my question to you is, how much do you have to spend or lose? Okay. We're going to get into another point in a little bit, but again, you are going to most likely pay a tuition to the market. That is just how this works. Okay. College, you're going to pay 4 years without seeing any job to make any money, right? With trading, hopefully it's quicker. You know, you can make money within a couple months to a year with trading, but you know, the statistics say your first year is going to be rough because you don't know what's what. Your psychology is not where it needs to be. You don't have the experience. So how much money do you have to spend or lose? And again, in the previous video, I talked about how I didn't do it the smart way because I didn't know what prop firms were. So I used my own money and I lost almost $30,000 my first year. And thankfully, I was in the position where I could afford to do that. But some people in that position, that would absolutely devastate them. So you need to properly align that. You know, do you have 6 to 12 months of savings where worst case scenario, if you bleed through it, it's not the end of the world? Do you only have $5,000? Like, that is my question to you. Because the fact of the matter is, people try to get into trading because they want to make money and they need financial freedom. And that's like the paradox, the oxymoron, if you will, of trading. You know, the more you care about trading or you care about money, the worse you're going to do. We're going to get into that later with psychology, but you kind of just have to trade as a trader and trade the chart and not focus so much on the money and the money and the money and the money because it's going to mess you up. So I think the healthiest way to do it is say, okay, I have this amount of money saved up. And if I lose it, yes, it's going to suck, but it's not the end of the world. I'm going to learn some lessons. Hopefully I get better over time, and just have that expectation. Because if you're penny pinching and you only have $100 to your name, I mean, you should click off this video. I'm going to be quite honest with you. You need to go get a job. It's not going to work. It's not going to work because you're going to constantly be stressed out about money and you're going to be on your last dollar and it's going to affect your decision making and your trades on the charts. So I'd much rather you come back and revisit this playlist when you actually have some breathing room and you understand what you're getting yourself into. Okay. I just want to be honest with you. I 100% want to be honest. I want the best for you. And that's, you know, that goes into my next point, which sometimes growth is not always financial. Okay. It's not just black and white. It's not, okay, I made money this month, I did great. I lost money this month, I did bad. You know, if you go from losing every month, but you're still losing, but then 3 months in, you realize some patterns like, oh man, you know, 3 months ago, I would have taken this trade, even though I shouldn't have, and made this mistake, but now I'm not. And I just saw that that trade failed. My discipline is getting better, you know, or, oh, wow, you know, before I would blow my accounts in 1 or 2 days. Now I'm holding on to these accounts for 7 days. I'm battling. I'm actually taking good setups. That is growth in itself, okay? And that's something that really helped me when I was becoming profitable. My first year, I lost almost $30,000 trading options, but in those months, I saw potential. I saw glimpses of hope. I saw strings where I was like, wow, if I can just do this more consistently, I see that it's there. Even though I'm ending the month red, I see little opportunities in diamond shinings where if I could just do more of that and be more consistent that way, I could actually make this work. And that is what kept me pushing and pushing and pushing. So that's also something to take into account. You know, success is not always measured just by financial. Sometimes you're going to feel confident and you're going to feel success based on things and little trading things and psychology things. So always keep that in mind, and that will help you as you experience adversity on the charts. Okay. And one of the last things I want to really talk about is strategy hopping. Strategy hopping is a big one. I just want to say, for me, kind of what I did was, like I told you in the previous video, I joined 10 different Discords over the course of a year and some change. And maybe like the first couple strategies, I was strategy hopping bad, where if I was trying something and it didn't work for a week or two, I would try something else. But at some point, I kind of understood, like, hey, I can't keep doing this. There's no magic wand or magic strategy that's just going to work all of a sudden and I'm going to print money out of thin air. I really need to give these strategies, if I truly believe in these strategies and I do some research and I'm like, okay, this is pretty popular, a lot of people seem to be having success with this, I really needed to sit there for a month or 2 months, understand the strategy from inside and out, make sure I'm executing it mechanically correct, and then start to gather data for, you know, a month or two to really determine if this strategy is for me or not. Okay, because so many people out there will just Google 2026 best trading strategy and try that, and they don't even fully understand it. And then after, they might have one good week and they're like, wow, this is great. And then they might have one really bad week, and now they're going back to YouTube and typing that thing all over again. And it's like, you're not even giving yourself a chance to succeed. You understand what I'm saying? So it's very, very important, you know, whether it's my strategy, whether it's another strategy in the future, you need to give it a chance, because trading is all about variance. You know, trading is all about variance. You're going to win, you're going to lose. If you have an edge in the market, a statistical edge, you will win more than you lose over time, but you're still going to lose. And, you know, if you try my strategy or any other strategy for a week, who says that it won't just be one of those unlucky weeks where it's a losing week in the variance, you know? So, you know, sit there, really start to journal, understand the strategy, give it a good amount of time. Don't just strategy hop because you didn't have an amazing week. And that's my best advice to you. That's going to help your growth, and you're going to drive yourself crazy, frankly, if you just try to do a new strategy every single week. Because trading, what I found, it's so good with clarity. The more clarity and focus I have, the better I perform on the charts. And when you have a million different strategies and confluences warping in your head, it's going to be so hard to read the charts clearly, because, you know, this model you learned a month ago is telling you to go long, but this model you're studying right now is telling you to go short. So your clarity's all messed up. Your decision making's bad. So that is just something for you guys. So that is everything I wanted to say in terms of expectations, misconceptions. What I'll close with is, again, I think trading is the best job in the world. Trading changed my life. I make a generous amount of money that I don't even have enough to do with, and I'm very blessed that I get to live this life. But that was also attributed to my hard work, my determination. I didn't quit when I was down $30,000 or whatever it was trading options. I kept going because I saw the potential, and now I get to reap the benefits. And I hope by you watching this playlist through and through the full length, you know, I'm able to help you just a little bit get closer to your goal. But at the same time, your expectations need to be realistic. This is going to take time. This is a journey. But if you can learn this skill, it will truly change your life. And I really, really believe that. Okay. So we'll see you in the next video. What is going on, guys? Welcome to episode number 3 of the course. I'm pretty sure this was recorded on a different day. Today, we're going to talk all about prop firms, guys. What is a prop firm? Why do you want to use a prop firm? We're going to go from head to toe. So this is going to be a longer video. So buckle up. Let's see. So, okay, I have this video from a while ago, but it still remains true. So I want to go over a few points. Prop firms versus live funds. Now, in the previous video, I believe in episode 1, I kind of spoke about how when I was beginning, I didn't know what a prop firm was. And I wish I did, because that would have saved me a lot of money. I deposited like 70, 80 grand into an options account when I first started. That was like from my savings and from my ecom money. And if I would have used prop firms and done the same exact things, the same exact steps, I probably would have lost a fraction of that money. Because if you just think about it like this, right? If you fund your personal account with $10,000 and you blow your personal account, you are losing your $10,000. But if you fund I don't know, I mean, if you try to get $10,000 in capital, which is technically would be 550K accounts, because each account is giving you $2,000 of drawdown. So if you fund 550K accounts, the investment is only how much you pay for the accounts, which is a ballpark estimate. It could be like $500-600. So it's a huge, vastly different game between prop firms and live funds. And I'm a huge advocate for prop firms because you can make the same amount of money, if not more, with the leverage these prop firms give you, while also limiting your risk. You are going to lose a lot less money. So as a beginner, it is important that you utilize this tool. Okay. So yeah, just to talk about prop firms here, again, not much risk relative to a live account. Now, there's a time and a place for a live account. I think, you know, we'll go into that later in the course, but you know, once you hit a certain amount of payouts or once you show a certain level of consistency, you can actually afford to put some money into a live account. And although you're using your own money, and basically the luxury of that is you're now bypassing all of these rules that these prop firms place on you. So, you know, you can't trade a certain way, or you can't make a certain amount of money, or this and that. With a live account, there are no rules. So I would say, like, yeah, when you're super profitable or consistent, it makes sense to look into a live account just to have no barriers on yourself. But until that happens, trust me, guys, it is 100% worth trading with a prop firm. It is a very good tool, and the prop firm industry is changing dramatically. I mean, when I was in the prop firm game, when I started like 2021, 2022, there used to, for all my OGs out there, number one, the average cost of a prop firm was way more expensive than it was now. I think Top Step back in the day used to be like $200 to $300 per challenge. And on top of that, there was a 2-step process. I guess there still is a 2-step process, but there was kind of like a stage for the account where you would have to make a certain amount in stage 1, then make a certain amount in stage 2, and then you're finally funded. So point blank period, the prop firm landscape is constantly changing. And honestly for the better, because a lot of new prop firms have popped up in the past couple of years because I guess they're just super profitable. And the benefit to the consumer, to me and you, is these prop firms are now competing with each other and offering great deals, discounts, everything, because they want your business. So I really do think it is changing for the better. So, and you know, you got to take advantage as long as you can. Who knows, like in the future, who knows in the future what the landscape looks like if regulation comes in and the United States government starts regulating, you know, the prop firms might be a lot harder. So like while in the current state right now, you need to be taking advantage because it's a great opportunity to make money and, you know, scale. So let's go into this next point. You know, so again, talking about live funds, a lot more riskier. You can't make 40K a month as easily. So I use this same example every single time, and we'll go into these questions in a little bit, but I use this example a lot on stream. Okay, if you want, let's just say in Apex trading, okay, we will go into this firm more in detail, but with Apex Trader Funding, they offer up to 20 funded 50K accounts. Okay, now you don't technically have $50,000 for every account, because on the 50K account there is only $2,000 of drawdown on each account. Okay, so you have 20 accounts with $2,000 each on drawdown. Now, if you hit a max payout with all 20 accounts, it's $2,000 per account, right? So times 20 would be a $40,000 best case scenario. Okay, best case scenario, and I've hit this before, and many people, it's not like crazy to think about. Many people on social media have hit this before. This is best case scenario. Now, so, and with the new Apex rules, we'll get into that later, getting a payout is easier than ever. They made the payout rules easier. So this is best case scenario, where if you were to get 20 accounts on a funded and get a max payout, you can take out $40,000. Now, super rough estimate, okay? Super rough estimate, but assuming you pass your first try, getting all 20 accounts is going to cost you anywhere in the ballpark of $1,800 to $2,000, okay? After you pay the account, after you pay the activation fee, all in, you're gonna be in there for $1,800 to $2,000. So even if, okay, even if, let's just say you don't pass the first set of 20 accounts at once, maybe it takes you 3 attempts. Now you're in for $6 grand, okay? Let's just say, for the sake of the argument, it took you a couple attempts, but finally you're in. $6,000 is your investment, right? That is still an insane ROI if you manage to hit the max payout. Whereas on a live account, right, it is much, much, much harder, okay? If you were to go deposit $2,000 into a live account, and I told you to go make $40,000, that is significantly harder. Because again, I mean, you know, you're not going to sit there and hit, I don't even know what that is, like a 10x, 40x. My math is not mathing, but like you would have to hit, just with 2,000 drawdown, you would have to full port it and then hit like a 10, 20x trade to hit 40K. Or, you know, you would have to full port it, double that to 4,000, full port it, double that to 8,000, and then just so on and so forth. And I'm just trying to illustrate how the road and how much harder it is to hit the same exact payout number with the same exact investment. And this is the point I'm trying to make. You know, trading with leverage is just way better. Trading with leverage is way, 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 way better, especially as a beginner, and you're gonna have to trust me on this one, okay? And that is where the real sauce comes in with these prop firms, is copy trading. If you're watching this and you're a complete beginner, I don't expect you to copy trade, and I wouldn't copy trade just yet. We will get into that when you should be copy trading, but you should just be starting off with one account, okay? For now, let's move on to our next point, guys. Okay, picking a prop firm. There's so many prop firms. There's so many rules. It's so confusing. What prop firm do I pick? Guys, I got you, bro. That's why I'm here, okay? I have been trading. I've been trading prop firm. It's been a minute, bro. I'm old. I've been trading prop firms for 4 years now. I've gotten a payout from so many different prop firms. I've gotten rug pulled by prop firms. I've gotten scammed by prop firms. I've done every single thing you can do with a prop firm. So I know what the heck I'm talking about. Trust me. So as of March of 2026, these are my top 5 prop firms in the game. I will go through them one by one, tell you the pros, tell you the cons, and then you can make an educated decision on which one fits you. Okay? So here we go. I need a little water break, and I'm not editing shit. Hold on. Little H2O there. All right. Here we go, ladies and gentlemen. Prop firm number 5 is Tradeify. So this is actually the only firm on the list that I don't trade with personally. And the reason is just because they only offer Tradeivate connection, and simply put, I can't connect that to my trading software, so I just don't trade with Tradeify. But they're a great firm. I hear nothing but good things. The reason I like this firm is because they blasted onto the scene last year with their straight to funded model, and this was like super revolutionary, because as I was talking about before, prop firm trading up until this point was kind of just, you know, 2 steps. You have your challenge phase, you have your funded phase. Tradeify was like, screw that. If you want to pay a little bit of a premium, we'll let you go straight to funded instantly for a higher fee. And it was just very, very unique, very, very innovative. Since then, they've added some other plans, like you have the select plan right here. This is what I see most traders trade with. They also, looks like they offer end of day drawdown. So again, it's just a really solid firm. I love the promos they run. I love the sales they run. Just very, very solid. They come in at number 5. Coming in at number 4, is going to be My Funded Futures. My Funded Futures is another great program. They came from forex and then transitioned into futures. Some of the benefits about this, they have the best support in the game, the best, like the best. So if that's important to you, you might want to consider them. All you have to do is literally just go in their Discord. It's super easy to find. It's on their website. And they have a 24/7 live chat where you can talk to a mod in their Discord and get a reply within 5 minutes. So I know how important that is for me. Like when I'm a beginner and I don't know how to set anything up, I'm going to have a million questions. And unfortunately, some of the firms on this list, they're behind the times. You'll have to submit a ticket, wait 24, 48 hours. And that's not the case with these guys. They're super fast payouts. Again, I think they have instant approvals for payouts. So really good plans. They also offer end of day drawdown. We'll talk. I mean, actually, we could talk about end of day drawdown now. Yeah, why not? Why not? We could talk about end of day drawdown real quick. So there's two types of drawdowns, guys, when it comes to these prop firm accounts. End of day drawdown and trailing drawdown. Okay. Now, normally with an account, you'll get $2,000 worth of drawdown. Okay. Now, end of day drawdown is the better type of drawdown. What does this mean? The drawdown is only going to be calculated by your end of day balance. Okay. So let's say your account is starting balance 50,000. Okay. Let's say you take one trade and you're up $300 on the trade and you don't take profits. You move your stops to break even. It hits your stop break even. You end flat on the day. Okay. You are still going to have your drawdown at 50,000. It's not going to change because you didn't take a loss. You didn't take a win. It just stayed the same. Now, the problem is with trailing drawdown, that is going to move because with trailing drawdown, it's not going to calculate your end of day balance. It's going to calculate just your peak balance no matter what from that day. So again, from the same exact example, if you have $50,000 on the account, you take a trade, you go up $300 and you don't take profits, and then that trade comes back and hits your break-even stop loss. Even though you didn't lose money on the trade, your drawdown is now it's not 2,000, it's 1,700. Okay, because your peak balance was technically $300 in profit. You just didn't take profit. So I know this does seem bad, but really it's not that bad for my model specifically and what I'm going to teach you guys, because we take profits pretty consistently. Every 20, 30 points, I'm trimming and taking profits. So this doesn't hurt my accounts that much. If you were like a huge risk to reward trader and you're holding for gigantic moves, 50 points, 100 points, whatever, then this would be a really big problem for you, because anytime you're up a lot of points and price comes back and hits your break-even stop, it's going to hurt your drawdown even though you didn't do anything wrong. But I think as like a short-term, I don't know why I'm getting hiccups, but I think as like a short-term kind of like day trader who my average trade is just a couple minutes, this really doesn't affect me as bad as it sounds. But just keep that in mind. There's two drawdown options. The end of day drawdown option is better, but it is more expensive. It usually carries a little bit of a premium to trailing. Okay. So if you still don't understand it, I would just go to ChatGPT and literally type the difference between end of day and trailing drawdown. Okay. So like I said, Tradeify, end of day drawdown, Take Profit Trader, end of day drawdown. If that's important to you, you might want to go with these firms. And again, you can use code TEMPO for any of these firms that I'm talking about today to get the best discount. Coming in at number 3 is Lucid. Lucid has been on the scene, boy. Lucid has been on the scene. So they have been a really, really upcoming and popular firm. And basically, they just adopted the old Top Step rules and just made them better. So, it's really, really good. You only need, I think, 5 days until payout. Let's click funded rules right here. So yeah, you only need 5 days of $150 or more. You can request a payout. There's no activation fee. There's no daily loss limit. There's no consistency rule either. So the rules are just super, super easy. And it's honestly not that expensive. It's under $100 if you use my code. So I did a poll on social media, I think a couple weeks ago, and this does seem like a lot of people's favorite prop firm. So they're on the rise. Really, really good plans. They have 3 different plans here, as do a lot of firms. They have direct to funded, they have flex, they have pro. I've seen the flex plans are their most popular, so I would check out the 50K flex plan if you want. It looks like these, you know what's funny? These first 2, what's actually funny is these first 3 firms are all end of day drawdown, and these last 2 I'm going to talk about are not, but these last 2 are my favorite, so go figure. Okay, coming in at number 2 is Take Profit Trader, guys. This used to be my number 1 prop firm for a while. It is now my number 2. This prop firm is not for beginners, okay? I would not trade with this prop firm if you're a beginner, but if you are intermediate or you're even efficient and you've gotten multiple payouts before, this prop firm is amazing because besides number 1, it probably gives you the chance to make the most money and extract the most profits. So it is a 50K account, 40% off. There's no activation fee, no consistency rule. And here's the kicker. None of these other firms have offered this right now, daily payouts. So normally you have to trade 5 to 8 business days to be eligible for a payout, but this firm offers you a payout as soon as day 1, as long as you're over the buffer. And you're asking, you know, what's a buffer? It's a amount you need to keep in the account. So with this one, a 50K account, the buffer's 2,000. So anything over $2,000 profit, you can take out the first day. So for an example, if you get this account and you make 2,500 day 1, you can withdraw 500 day 1 instead of waiting, you know, 5 to 8 trading days and then requesting a payout. So it's pretty nuts, especially with the no consistency rule. I've seen people like just go super high leverage and just try to hit a gigantic trade and take advantage of that, and it's worked out for them. I actually want to show this on the video. One of my members in the Discord got a $30,000 payout right here with this specific prop firm, Take Profit Trader. So again, I don't think it's for beginners. I think number 1, which I'm about to explain in a little bit, is better. But as an intermediate trader or someone who has experience, this is the go-to. You can trade up to 5 accounts, and it's absolutely amazing. It's absolutely amazing. Coming in at number 1, ladies and gentlemen, is Apex Trader Funding. Now, up until this point, all 5 firms that we have talked about have only let you get 5 accounts. That's it. That's pretty much the industry standard. All of these 4 prop firms we just spoke about, they only allow you to take 5 funded accounts at once. That's the max leverage. With Apex Trader Funding, they are offering you 20 accounts at once, okay? And like I said at the start of the video, leverage is the number 1 reason why prop firms are so powerful. The ROI, return on investment, the leverage, the potential is insane, okay? And Apex is offering you the most leverage, simply put. Now, in recent history, or I guess recently, I don't know why I said that, but recently, they have made their firm even better, okay? A lot of people complained that, hey, you only offer trailing accounts. Well, they came out and they said, look, we're gonna one up and offer end of day trailing accounts now too. So on top of that, they increased their consistency rule, so you can make even more money per day now. They've done so many good things with this new update. It is my number 1 firm. It's not even close. And for people, you know, they pay out. There's been so many people in my Discord right here. One of my members, Day Trader, has taken out $20,000 in payouts with Apex this year alone. So they are number 1 by far. And the good thing about this firm is they're super cheap. So this is the best. Not only is this the best firm overall, it's the best firm for beginners, because as a beginner, you are expected to make mistakes, okay? I'm not expecting you to pass your first eval or even sometimes even your first 10 evals, right? As a beginner, I'm expecting you to make mistakes, take lessons, learn, and adapt. And some of these other firms, you know, you have Tradeify, $100, My Fund of Futures, $100. This is $90. Like, Apex is so good because the barrier to entry is low. And it's good because you don't want to paper trade forever. Excuse me. I see a lot of people out there and they're like, hey, I've been paper trading for 6 months. I've been paper trading for 12 months. That's not good, because paper trading is only good for confirming your system and mechanical trading, but that is just one side of trading. The whole other side of trading is psychology, okay? Emotions, greed, rage, tilt, all of that. And you need to start practicing that and strengthening your psychology as fast as possible. And the best way to do that is just have a little bit of skin in the game. You know, you want to just simulate that environment where it feels real and it feels like real money's on the line. Because, you know, if you're on a paper account, it's not real. You're full porting, you're doing this, doing that, blah, blah, blah. But that's not really how you trade if you had $1,000 or $100 of your real money at stake. So with this, at least you put up 20, 30 bucks at a time. So you can like somewhat take it seriously and start to develop that psychology. So Apex, by far, my #1 prop firm. You know, they have trailing drawdown, they have end of day drawdown, so pick your poison. If you want to pay a little bit more for those type of accounts, be my guest. It is $20 with code TEMPO, and they offer up to 20 accounts. It is absolutely insane as a prop firm, okay? So now we'll end the video off by just asking you guys a couple questions. We are going to build a prop firm roadmap for yourself. So #1, when you're looking at these 5 firms, these are the questions you need to ask yourself. Have you ever gotten a payout before? Okay. If the answer is no, you go to Apex. 0 questions asked, in my opinion. Okay. That is my opinion. If the answer is no, if you've never gotten a payout, Apex should be for you. That is the only firm that you should even think about until you get a payout. Okay. Because the trade-off with Apex, the reason why it's so cheap, the kicker is it's a little harder to get a payout than the other 4 firms I mentioned. But again, as a beginner, you're not expected to get a payout right away. So I'm okay with that trade-off. Now, again, if you have gotten a payout before and you are kind of, you know, intermediate or advanced, you know, you can look at a take profit trader. You can look at a Lucid. You can look at, you know, a My Funded Futures or whatever. But that is just my answer to that question, okay? Second question, have you ever passed an account legitimately? What I mean by that is not full porting. A very common method that people do, including myself, when I trade evals, I don't want to waste any time on evals, okay? I think as a beginner, it's really important that you do that at least once. Take it from 0 to the profit goal, just to build that confidence with yourself, just to build that conviction. But once you've done that one time, there's no reason to do it anymore, in my opinion. Why am I going to waste 3 weeks, 4 weeks on an eval when I could be taking those trades on a funded because I've already gotten a payout before? I know my system works. It's just not a good use of my time. I'd rather blow 2 to 3 evals trying to pass one than take 3 weeks on one eval and pass 0, if that make, or and fail 0, if that makes sense. So yeah, you know, that's another question. The other question is, so when we build the roadmap, okay, have you ever gotten a payout before? Have you ever passed an account legit? What is your debt with prop firms? What is your long-term goal? Okay, I'm just going to kind of put myself in the shoes. Why am I so bright? We're doing this, no editing, but hold on. I got to lower myself. Sorry, chat. Wait a second. No editing. Okay, so we're just going to, I'm going to put myself in the shoes of one of you guys. So let's just say I'm brand new, or like I'm somewhat new. I have like $3,000 debt. And I've never gotten a payout. Okay, so if you've never gotten a payout before, I would trade Apex. It's the most user friendly. If you've never passed an account legitimately, I would do that. I know it sucks. I know it's time consuming, but it's just what you have to do. It's like a checkbox in your journey. You just have to do it for your psychology and for your conviction. Trust me. Okay, now if you have passed an account legitimately, in my opinion, you can full port them and save some time. What is your debt with prop firms? That's question number 3. Very, very important. Your goal should be to get break even as quickly as possible. Not as quickly as possible, sorry. But that should be your #1 goal, to get break even. It doesn't have to be quickly. You don't want to force it and make stupid decisions. But, you know, for me, I was down like $25,000+ trading options. And that was just my primary goal. Like when I was trading futures, I wasn't you know, I wasn't thinking about, oh man, like, you know, I want to make 100K a month. Like, all I thought about was, I just want to clear that debt. I just want to clear that debt. I just want to clear that debt. Because once you do clear that debt, it's like a weight lifted off your shoulders. It feels so good. And it allows you to just trade more freely. But again, I will say, if you're down, let's just say you're down $5,000 from prop firm debt, your first payout does not have to be $5,000. Do not think that, oh man, I have to go for this and knock it all out in one shot. You can chip away at it. You know, you can take your time and chip away at it. It's not going anywhere. It's still there. You know, if you want to hit a $1,000 payout and then a $2,000 payout and then a final $2,000 payout to get to 5,000, that is completely fine. So your number one goal is to get debt free with these prop firms. And then what is your long-term goal? You know, set realistic goals, try to build on them, but don't just be like your first month, like, hey, I want to copy trade 20 accounts and hit 100K a month. Like, there's steps to these things. For me, you know, first, it was just having a green month, a profitable month. Then it was, you know, I want to have a 5K month. Then it was like, okay, I want to have a green month 3 months in a row. Then it was the big milestone, the 10K month. And then it kind of just built up little by little. Every time I was increasing that milestone, you know, I added some more accounts, I added some more leverage, and now I stand here today at the end of it all. So that should be your goal. Just kind of set realistic, but, you know, achievable expectations, and just go from there. So that is my full prop firm breakdown, everything you need. Again, if you're a beginner, I would just trade with 1 to 3 accounts, get a payout on that account, and then use that money to fund your other accounts. If you're a beginner and you're trying to trade 20 accounts at once, I know the leverage is enticing, I know the numbers are enticing, but the chances are your psychology is just not ready for that yet, and you're just going to hurt yourself in the long run. So that is everything. We will see you on the next video. Take it easy. Peace. All right, guys, in the next video, we are going to talk about data and journaling. Before we even get into the nitty-gritty of the strategy, we need to set the expectations and the groundwork of what we want to do, okay? Let me be very, very clear. You are not going to win in the stock market every single day, okay? Whoever's telling you that, if anybody tells you that on social media, they are lying. They're trying to steal your money. Run far away, okay? Trading is a game of probabilities. You need to win more than you need to lose, or your winners need to be bigger than your losses. And you can still be very, very profitable in the long term. Again, it's an ROI game, risk of return on investment, right? So here are the stats of my model. We already spoke about this in a previous video. I have a 76.8% win rate on average. Now, that is going to vary. You know, that is going to vary a lot, because in January, if I just go to my Twitter right here, in January, I had an 81 or 82% win rate. Very, very good. It was above expectation. In February, I didn't. I think I had like a 60 or 65% win rate in February. February was tough. And then this month, currently recording this on March 16th, I am back, and I think I have like an 80 or 81% win rate again. So it is all about fluctuation. You're going to have easy months. You're going to have hard months. Some months are going to be easier than others. You know, December and November are, historically speaking, the hardest months to trade out of the year, for especially for my personal experience. And that's okay. But on average, I know that if I just keep continuing my process, I will, at the end of it all, I will have about a 76, 77% win rate. And that is what keeps me moving. That is what keeps me moving. You're going to take wins, you're going to take losses, but every time I sit there and I take a trade, that's all I think in my head. This is a 77% chance of me winning this trade. Boom, win or lose, I don't care. Next one. This is a 77% chance, 77% chance, 77% chance. And that is all I think about. You know, I always use this analogy, but like if you're a poker player, there's, you know, the best two hands in poker is pocket aces and pocket kings, right? And they are not guaranteed to win. I don't know the exact percentages pre-flop of your chances to win with pocket aces. I want to Google that. I want to Google that. No, we're not going to do any editing. Chances of winning pre-flop with pocket aces. That is 85%. Okay, that's even higher. Okay, but the point I'm trying to make is, so the best hand in poker has an 85% chance to win pre-flop, meaning before the cards are dealt. And, you know, all the biggest players in the world willingly, every single time, without question, go all in when they get aces, right? Or pre-flop, or they bet very aggressively, right? You know, and what I'm trying to say is they just leave it up to probability. They say, this is the best hand I have. This is the best possible situation where I can return at the end of this hand with more money than I started with. I'm going to put all my chips in the middle and let the probabilities play out. Now, again, we're not going to be that extreme and say you're going to full port the trade, because you're not. But that is kind of how I think about it, is like, you know, every time I take a setup and my checklist is there, which we will get into in a later video, I have a 77% chance to win. These are my pocket aces. Time to put my money where my mouth is and just let it play out, you know? But I'm not gonna sit there and when I take one loss, start questioning my model and start doubting myself and start doing, you know, pointing fingers. No, that's what gamblers think. You know, real traders, they just think, okay, I lost. It's a part of the system. Even if you have a 77% win rate, what does that mean? You are going to lose 23% of the time. That's just how it works. So you're going to lose, you know. Another common misconception people do is like, hey, if after I take my first loss, should my second trade, should I go lower on my risk? You know, how much I'm risking? The answer is no. You know, if you risk 300 on trade 1, you should be risking 300 on trade 2, especially if it's the same quality of trade. If you're saying, you know, trade 1's a really good setup and trade 2 is a really good setup, even if trade 1 lost, you should be trading the same on trade 2, because again, you don't want to skew your numbers, right? If you lose 300 on trade 1, but you only risk 150 on trade 2 and you make 150, you have to win double the amount of trades just to get back to your even point. Does that make sense? So I just want to give you the kind of raw breakdown of numbers and expectations. You can backtest these results for yourself. I'm very, very confident you will find similar results in the 70s. Obviously, if you are backtesting, you need to make sure you're using the correct checklist. But we'll get into that in a later video. But yeah, that is just, you know, how I think about trading. I stopped thinking about trading so emotionally. I stopped caring about the money and all of that. And I just tried to follow a system that I knew was repeatable, mechanical, and I knew that worked. And you just follow it and you just increase your leverage over time. And when I say increase leverage, I'm just saying you add more accounts. And that's how you go from, you know, 10K a month, 50K a month, 100K a month. That's all you're doing. You know, from my biggest month ever in props to my very first profitable month when I started this system, I've done the same exact thing, the same exact steps. The only thing I'm doing differently is I'm just trading with more accounts. That's it. So yeah, that is my advice to you guys. And that's just, I think trading worked with me because I'm just a very numbers guy. Like my brain, my logic, I've always been that way. I always just think logically. I always just think numbers. I don't think emotionally or, you know, delusionally, I guess is the word. And that has worked to my benefit when it comes to trading. The next thing I want to really talk about is Notion. You guys need to be journaling, man, especially if you are unprofitable. I went so long with journaling when I was trying to become profitable. The best journaling software that I found is a free website called Notion. And you can basically just input all your data and some stuff about your trading. Now, this is one of my students' journals, so I'm just going to use this as an example. But yeah, the reason you want to journal is because you want to avoid going in that hamster wheel. If you're unprofitable and you don't really know why, the exact reason why, and you're just going through the motions, Einstein's definition of insanity is doing the same thing over and over again and expecting a different result. And if you never sit back and reflect on your mistakes and try to tweak and refine your system, you're going to be stuck in that hamster wheel forever and you're never going to be profitable. So I know it might be boring and tedious and you don't want to do it, but journaling will help you more than you ever know. So this is an example of my journal template. You know, I write down everything. I write down, you know, the time frame I'm entering the trade on, you know, whether I was long or short, me grading the trade, how many contracts I went, how much money I made or lost, just so I can look back, and after, you know, a month or 2 months, I can really start to notice patterns in my trading and be like, okay, you know, every time I'm winning, I'm doing this great, but every time I'm losing, you know, I may be forcing things. I may be going too heavy on the contracts. I may be doing this. I may be doing that. So you really want to start to gather data and recognize your tendencies, I guess you could say. So that is pretty much it. And then, you know, also you can write a few sentences about the trade just so you can understand your conscious and what you were thinking and talking about in real time. It's just very important to go back on these sort of things, man. I'm telling you, especially when things go right. You know, you might have a good stretch of trading and might sit there and be like, damn, I don't have to trade ever again in my life. I finally figured this out. That's wrong. Because what I've seen some people, they'll go on a 2 to 3 month stretch of where they're trading really, really good. And then they go on a dry spell and they just can't figure out what happened. They're like, what the heck happened? Is it the price action? Is it me? What's going on? And that's like a really valuable thing where if you could have journaled that whole 2 to 3 month stretch of when everything was working and you were profitable, you can actually compare that to current day, you know, and make some adjustments, you know? So that's pretty much it. Journaling's super important, especially when you're unprofitable. For me, I don't journal every single day just because a lot of the days are just so mechanical and I've done it a million times, but I definitely journal a few times every week when, you know, it might have been tricky or I think the trade was special and kind of interesting to talk about, but that's just what I do and what's kind of helped me. So those are the two things I wanted to go over, just statistics, raw numbers, and the trade log. The last thing I'll show you is, again, like this is just my kind of public journal, my trade recaps in my Discord. You know, I win a lot. I win way more than I lose, but I do lose. You know, you can see all the green check marks here. This is me winning almost every single day. But then every once in a while, I have a day where I don't take a trade, or, you know, every once in a while, I have a day where I take a loss and I end red. So it's like, you just need to think about trading in the bigger picture. Trading doesn't matter on the day. It doesn't even matter on the week. It matters on the month and on the year, you know? You don't even if you're red one day, you don't just sit there and you're like, oh man, you know, I have to get back all this profit right this second or else I'm going to feel like terrible, you know? No, like if there's no other opportunities, you move on to tomorrow and you just sit there and you're like, hey, listen, if I continue with my process and I do what needs to be done, I will end the month green. That's all I care about. And that has helped me, you know, not be so zoomed in. You know, you need to zoom out when it comes to trading, and trust me, it will become a lot easier. What is going on, guys? It's another video. We are back talking about kill zones. Guys, kill zones are so important. So important. First of all, what is a kill zone? Okay, a kill zone is a window of price where price is going to deliver to its objective or to liquidity. Okay, we really only need to worry about 3 kill zones. We have the Asia kill zone, which is 8 p.m. to midnight. This is all New York time. We have the London kill zone, which is 2 to 5 a.m. And then we have the New York AM kill zone, which is 9:30 to 11 a.m. Those are the 3 major kill zones, as you can see on the screen right here. And these are honestly the most 3 common trading windows. Okay. Now, the way ICT teaches, price only moves in 3 phases: accumulation, manipulation, and distribution. Okay, that is the way the market moves. It's only doing one of these 3 things every single time. Okay, now we want to be trading during distribution. Why? Pause the video and just take a guess why. If you guessed volume and volatility, you are correct. Okay. Distribution is going to have the cleanest moves, the best price action, the best legs, and the most money to be made, right? Because you could see down here in this accumulation phase, it's very choppy. The range is probably not that big versus this phase right here. And that's why we trade New York AM, because not every time, obviously, there's no guarantees in trading. Everything is probability, but it is very likely that during the New York AM window, we will be in the distribution phase. So that window gives us the best chance to make money. That is when our win rate and our edge will be the strongest. I'm hiccuping a lot, so I don't know. You just got to ignore it. But anyway, next thing I want to show you is a verified backtesting result from one of my Discord members who basically took my model. He's unbiased, didn't pay this guy. I can show you him in the Discord. Actually, I'll show you his, one second. Here you go. If you want to go contact him and message him about the results for yourself, here is his Discord. His name is Tiger Fan. Shout out to him. He went back, and I think for like 8 to 10 months, I don't know if this was a full year, but it's definitely like 8 to 10 months. He just back tested the model, and he found that this model had a 76.8% win rate on average. For a 1-to-1 risk reward target, it was 80%. For a 1-to-2, it was 62%, and for a 1-to-3, it was 45%. And again, that is over 177 trade sample, which is significant. That a larger sample just means the validity of the results are even greater. So now, the reason I mentioned the win rate is because that specific win rate only applies to the New York AM window, okay? And what I have noticed is if I trade this exact model, the exact process, the exact approach in any other session, you do not see the same results. You typically see an 8 to 15% dip in win rate, okay? So if you were to trade this during London, or you were to trade this during Asia, or you were to trade this during PM, it is not as consistent. And for me, I will say that like when I was starting out, and I've talked to a lot of students, they always want to trade, you know, they always want to be in a trade. They get addicted to trading. They're constantly opening the charts. You know, they'll take a trade and then get off and then go somewhere. And then in the car, they're pulling up TradingView and looking at price action. And it becomes an addiction. And the more you care about it, the worse you're going to do. And I know that sounds crazy, but you're not going to trade mechanically. You're going to trade more off emotion and off impulse. Okay. And when you just get to a mindset, and we'll talk about more psychology in the later videos, but when you just get to the mindset, like, you know what, here's my model, here's my strategy, this has an edge. If this happens, I will take the trade. If not, I will not take the trade. Until you can get to that point, you're going to be in a constant uphill battle with your emotions. So yeah, it is very, very important that if you can, please just trade inside this window. It's a 90-minute window, New York AM session. This is where I go live every single day. And again, I will say on average, I catch a trade every single day. I would say on average, there's 1 to 3 opportunities every single day where I would consider that a high quality trade that you can take. And if we just go to my trade recaps in my Discord channel, today was break even, which is funny. I didn't find a trade, but you can just see most days we are taking a setup. You know, you could see here, so break even, then I was green, 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 break even, green, 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 green. Like, you can see more often than not, I am finding a setup in that specific window. And, you know, maybe like once a week, you know, maybe like 3-4 times a month, I will actually have break-even days. And those break-even days are okay, because guess what? Like, I came to a point where I'm like, look, this window is where I want to be risking my money, and this is where I know I'm going to have the highest win rate. And if I can't find a setup in that window, I'm okay moving on to the next day. But the worst thing you can do is, you know, try to go scout PM when you shouldn't be, because PM, again, once the New York AM window ends at 11, I notice a dip in price quality. Price starts chopping, the ranges become smaller, and you are just not going to be as successful outside of this window. Trust me. Same thing with Asia. Like Asia, I can literally count on my right hand how many profitable day traders I have met who trade Asia full time. It just doesn't happen. It is a way smaller range, way harder price action to predict. And it's just bad in my opinion. I mean, some people make it work, but I hate it. London's a different story. I think if my time zone would allow it and I had to, I would trade London. Because with London, we'll go into the strategy a little bit later, but you could definitely do some things during London and make some money. So, you know, if you're not able to trade New York AM and you have to trade London, you can do that. Again, you may see a little dip in the win rate compared to my 76 or 77%, but I still think you can make it work. But yeah, New York AM is the bread and butter. This is the holy grail. This is where all the volume is. This is where everybody in the New York Stock Exchange is trading. So if possible and your schedule can allow it, just trade inside this window and thank me later. So that is the whole breakdown on kill zones and timings. I just kind of want to jot down my bullet points really quick. So trade the New York AM kill zone. If you don't find a setup in this kill zone, it's okay. Like, you can move on to the next day. You don't have to force a trade just for the sake of it. And this kill zone, the reason why it's so good is, again, the best volume, the best volatility. Price is going to deliver to liquidity the best, which we'll talk about later. And it's just the best opportunity to make money, man. All right. See you next video. What is going on, guys? We are on the liquidity video. This is super, super important. So grab a snack, get comfortable. This one might be a long video. So in this course, we are going to go through my entire checklist and explain everything, right? These 6 points right here are comprised of all the different things that create a profitable system. So I'm going to break down every single one. So far, we've done the kill zone. We've talked about sessions, why that's important and everything like that. Now we're going to talk about liquidity and liquidity sweeps. Okay. So you can see point number 3, I say major liquidity sweep. And again, if you have no idea what that means, I'll kind of break it down for you, but let's just paint a picture, try to make it very simple. Okay. Let's just say for whatever reason, you were in the markets and you were taking a long here because you wanted to, you know, you think the market's going to go up. So you're going to long here and then aim for up here as a target. Okay. Where do you think you would put your stop loss, right? You would put your stop loss down here, right? At the wick, you know, at the bottom of the candle, whatever the case may be. That's how retail investors and traders are going to think and act. That is called liquidity. Okay. So if we just fast forward a little bit, you know, let's just say whatever you want to enter long here, you want to aim for up here. And then you put your stop loss down here, right? That's what all the retail investors and traders are going to do. So you can see, boom, 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 the trade ends up working. It does go up a little bit. Now, their stop loss is still down here. You know, for all the people that they're holding, or maybe they're swing trading or whatever, the liquidity is still down here. Their stop loss is still down here. So liquidity, the liquidity sweep comes when that stop loss gets rated, right? So you can see if we just kind of fast forward a little bit, later on in the day, right? The low is still there. You know, the low is still there. For all of the people who enter this long here, they are technically still in the trade and their stop loss is here. Okay. And this would be determined as the London low. Now, if we just fast forward, boom, 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 bang, the stop loss finally gets swept 3 hours later. What is going to happen? This is called the liquidity sweep reaction, okay? Because there are so many resting orders here, that is called liquidity. What happens is this phenomenon called the liquidity sweep. Price seeks out the level, takes that liquidity out. Now, all of those people who are in long here, right? They're forced to get out of their positions when we sweep the level, and that causes this liquidity sweep reaction, and you typically see reversals from those liquidity levels, right? Because of this phenomenon. So that is kind of how you need to understand liquidity. It is just resting orders, people having buy limits, sell limits, stop limits, whatever the case, stop orders, whatever the technical term is. And you're basically, once that level gets invalidated or swept, you are expecting price to react out of it and reverse. Okay. That is the idea. So that is just one example. We're going to go over all of the liquidity levels I like, and then we will kind of talk about how to mark them, because I think as a beginner, that's going to be one of the most challenging things is like, you know, how do I mark all of these liquidity levels, and it's intimidating, but it's really not that complicated, I guess. So we're gonna go through them one by one. These are my top 5. Can I remove that? Yep, I can. These are my top 5 liquidity levels and the main ones that I use to trade every single day. So the first one is New York AM high and low. Now, this level is probably one of the ones we use the least. And the reason is because I trade in the morning, right? So let me just give you a visual here. Let's go to the chart. We are going to okay. So let me just mark out the 9:30 open. 9:30 open. Boom. Okay. So here's the 9:30 open. We're going to just mark out 9:30 to 11 a.m. Keep it nice and simple. Okay. Boom. So this, if you watch the kill zone video, this is the New York AM kill zone, 9:30 to 11 a.m. Now, out of every single session for the indices, which means NQ and ES, when you trade these two tickers, there's going to be the most volume and volatility and liquidity in this specific window of time. Okay. So what that means is when this session ends and 11 a.m. is passed, you can actually mark out the high of that range, which is the New York AM high, and you can mark out the low of the range, right, which is going to be the New York AM low. And that both of those levels are going to have a ton of liquidity, right? Because we already just talked about that. So what we're expecting is if you do trade after the New York AM, you know, maybe if you're a lunchtime trader, I don't know why you trade during lunchtime, but if you're a PM trader, like if you trade later in the day, that's not AM, this is going to be a really, really useful level for you, because all you have to do is just pretty much wait for the New York AM low to sweep, and then you're expecting that liquidity reaction that I showed you earlier. And it's the same thing with the high. You know, if price were to come up here, sweep the high, you're expecting it to reverse and bounce right off. So that is how you use the New York AM high and low, kind of like in this example here. And it's a good level. I just don't use it a lot because I personally trade the New York AM session. So a large percentage of the time, I'm already done trading at 11 a.m. So I don't really have to use this level, but it is a really, really good level. You know, if you want to go back test, just literally go back test, go look at NQ every day, mark out the New York AM high and low, and see how price reacts once it sweeps that high and low. Okay. So yeah, that is going to be my 5th best liquidity level, and that is how to mark it out. Number 4 is 1 hour highs and lows. Okay. So this is going to be a little bit more complicated. Now, 1 hour highs and lows. Okay. Let's try to make this as simple as possible. Now, for the 1 hour high and low, we're on the hourly time frame right here. We only care about swing points, swing highs and swing lows. And I know what you're saying. Tempo, what the heck is a swing high and swing low? A swing high and a swing low is the highest and lowest point in a set of 3 candles. Okay. So as an example, you see, I want to make it easy for you guys. Yeah, like we can make it easy here. Okay. So all you have to do is just kind of look at like a cluster of 3, you know, a cluster of 3. A cluster of 3. That is how you can see the swing highs and swing lows. So for an example, this red candle right here, this wick is not a swing high because it's not the highest point in a set of 3 candles. This high is the swing high, right? Because if you just count, you know, here's candle 1, here's candle 2, and then here's candle 3. This candle is the highest candle. That's your swing high. So when we talk about 1 hour and 4 hour high and lows, that's how you have to think about it. So, you know, if price were to come up here and sweep this high, I don't really care about that high. It's not the swing high. This is the swing high, right? So that's what I would have marked out. And then once price were to come up, tap that liquidity, I'd be expecting that same reversal pattern that I've been talking about the whole video. Okay, I want to try to find an example for you guys. Let me go again. We're not going to edit. We're just going to do a whole shebang. So let me go on my Twitter. We'll find a live example. I post all my tweets on Twitter, my trades. So let's just find literally, let's just find something from Twitter and then we'll use it. Hourly buy side liquidity. Yeah. So let's go to this day, March 9th. March 9th on the 30-second time frame. Let's go all the way back at about 9:30. Let's take a look here. Okay. Alrighty. So let's find the trade. I actually took this trade. So here's the trade right here. Now let's go on the hourly time frame first. And what can you see? Right? Boom. What can you see? We swept out this swing high right here. Okay? We swept out this swing high right here, because if we go even farther back, you can see this is clearly the swing high, right? Here's candle 1, here's candle 2, here's candle 3. So this wick is your swing high, okay? And once price sweeps this high, I'm expecting it to reverse and come back down, okay? And that's exactly what we did. If I just fast forward a little bit, we drop down. I forgot to mark the high, actually, my fault. So we're gonna mark the high. Boom. Okay, now we're gonna drop to the 30-second time frame. Okay, so this is marked out as the 1 hour swing high, and we're just on a lower time frame, 1 hour swing high, right? So once price, we're gonna get into the entry model and everything like that, so I'm not gonna go super in depth with that, but when price comes in to the 1 hour swing high, again, like I was saying before, there's a ton of liquidity resting up there. There's a ton of people's orders sitting there. And if price actually sweeps that level, all of their orders have to be taken out. And we're expecting that reaction, right? We come up, hit this high. Now I'm expecting price to reverse back down. And that's exactly what it does, all the way back down to the bottom, you know, of the range. So it's very, very simple, very, very simple. And I actually took this trade with my Discord. So using these examples in real time. Now, I do want to say a caveat. For me, it's not hard because I've been doing this so long. So I kind of just see the levels. But for you, if this is really hard to keep track of all the different levels and it's like moving super fast, you can just buy my indicator and it will mark out all the levels for you. And if that's something you want to do, great, because it automatically, like if I go here, I'm pretty sure it'll show this. It should show this swing high. So, yeah, so it literally marks the swing high automatically. So you don't even have to do anything right here. Boom. So you see it's marked out in yellow or green. Oh my God, I'm colorblind. Yeah, so my indicator just breaks it all down for you. You could see very clearly that price is actually saying it's a 1 hour swing high, you know, and all you do is just wait for that level to hit and then look for that reversal pattern. So that's also an option. You can go on my Discord, click the My Indicator channel, and it's pretty easy to set that up. So that is my 4th favorite liquidity level that exists. Now we have number 3, which is previous day high and low. This is a really, really nice liquidity level because, again, the more volume and the more liquidity, the stronger the reaction will be with that reversal. That's what I've seen in my experience, right? So just logically speaking, there's going to be a bigger liquidity reaction if we sweep a daily level versus an hourly level, right? Because there's 24 hours in a day versus just 1 hour. So, I don't know if I'll be able to find an example. Let me see. Let me see if I can find an example here. Yeah, there's a high right here. I mean, it's not the most amazing example in the world, but we'll use it. March 4th, 10:40 a.m. Let's go find that. And again, the same exact principles are going to remain. We're looking for, you know, swing highs and lows on the daily time frame. 10:45, March 4th, 10:40. Okay, boom. March 4th, 10:45. Boom. All right, let's take a look here. Let us wait. I just want to make sure I have the right time lined up. Okay. So it should be right here. I want to just go on the daily real quick let's see what we swept. So I'm going to go all the way down to the daily, going to the daily time frame here. And you can see, yeah, this is a swing point, right? You have, here's candle number 1, here's candle number 2, here's candle number 3, and then the highest point of those 3 candles is this candle. So whenever price comes up and sweeps this level, we're going to expect that liquidity reaction back down. Okay, so that's exactly what happened here. This was a daily sweep, which is super strong. And essentially, once again, let me mark this level. Sorry. Mark that there. Then I'm going to go back down. So, you know, sometimes you get the reversal. I would say sometimes you get this reversal pattern quicker than others. This is one of those examples where it kind of just took a long time to reverse. You know, you could see we reverse it right here, but then price even pumps up a little bit more, but then eventually does that little reversal pattern. So I would say the faster and the quicker it actually makes that reversal pattern, the more likely it is that the reversal will happen and kind of like higher quality the trade will be. So you do want those instant reversal patterns, but it can still work if it looks like this. Just keep that in mind for the future. So same exact deal. This is a daily hot swing, daily swing high. All we're doing is we're waiting for price to go into the level and then reversing out of it. It's very, very simple, guys. You know, we look for the same exact thing every single day. We wake up pre-market, mark all your levels, wait for one of our liquidity levels to sweep, and we're looking for a reversal to the opposite side. And again, we'll get into the entry model later, how to get in, you know, what we're using to get in, but all you need to know is this stuff right now. Number 2 is overnight high and low. This was the very first example that I showed you. What I mean by overnight high and low is just Asia and London high and low. Now, to use the Asia kill zone, it's 8 p.m. to midnight. This is New York time. And London session will be 2 to 5 a.m. Eastern New York time. Again, you can wake up every single day and mark these levels out yourself, the ranges, but I just have my indicator that does this for me. And if you want to get the indicator, it's in the Discord. Okay. So every single day, I don't have to wake up and manually mark them like this. I can just see what my indicator is showing me. And I will find another example. Let's do it. So we're literally just doing this in real time with no editing. You see, just trying to see when I take one of these trades. Oh, this is a really good example. Wow. This is a really good example. So, I mean, I could just keep this example here. We don't have to go to the chart. You get the idea. But like right here, you know, I have my, actually, I want to show it to you guys. January 30th. January 30th, 9:40 a.m. January 30th, bang, 1 minute time frame. Okay. Let's do it. Okay. So you can see right here, this is exactly what you need to be doing every single day. Like you wake up, boom, where the first question you need to be asking yourself, where are my liquidity levels, right? Here are my liquidity levels. You either mark it out yourself manually or get my indicator and it'll mark it out for you. The indicator is showing me, wow, I have Asia high right here. That is a liquidity level. What are we expecting? We're expecting price to go into this liquidity level. And then once it does, reverse back down to here. Okay, that is what we look for every single time. And as you can see, boom, the liquidity level gets swept here. Now, another good question I get is like, oh, do you want price to wick the level, close over the level, etc., etc. A wick or a close is completely valid. Either one, it doesn't have to close. In all honesty, a wick is actually better, and I'll get into why that is later in another video. But yeah, wicks, closes, whatever. Price just has to cross above that threshold, and it is a valid liquidity sweep. And now again, we're expecting price to reverse back down from that sweep, and you see it does that perfectly. So It's magic, man. It's literally magic. It's like these magic levels you can just take bounces off of. It is absolutely amazing. It's absolutely amazing. So that is number 2. And then number 1 is a very, very niche scenario, which we can honestly go over it in this video. Yeah, we can honestly go over it in this video. First of all, I need to find a data setup. I don't know if I took one recently, because this is a very niche scenario. Oh, here it is right here. Okay, so let me break it down to you, ladies and gentlemen. Every single week, okay, where is my recording? Okay, every single week, guys, we have economic news. Okay, that is news that the government is going to basically release, you know, about unemployment claims, inflation, job reports, whatever. They're going to release economic news. This website is called Forex Factory. It shows you the news every single day. The news is graded based on impact. So it is red, orange, and yellow. The only one we really care about is red. The reason why it is marked as red is because it has a high, what's the word I'm looking for? High chance that it can impact the market, right? And cause crazy price action. So that's why every single day you want to wake up and look at the calendar and see what is dropping today. Because obviously you don't want to be in a trade and then there's some red news that comes out and it's going to spike the market like crazy and cause chaos, right? So this is where the strategy comes in. Whenever we get this high impact news, you have a chance. It's not guaranteed, but you have a chance of getting a data candle. What is a data candle? A data candle is that 1 minute when the news drops where price is spiking like crazy and creates an erratic or, you know, weird looking candle. You know what it looks like. Like this is the data candle, right? Look at all these other candles and then just look how weird this black candle looks, how big that wick is. That's irregular. That is from the data that dropped at that specific time. Okay. Now, how you can really take advantage is because when we talk about liquidity, there is so much liquidity at this specific candle because a lot of people are trading at that time. They're trying to abuse the volume and trying to make quick money. So, you know, it's called the data candle. There's a ton of volume, liquidity, buyers and sellers trading at that specific time. So what's going to happen is price is going to try to sweep out one side of the candle, and then the algorithm is going to immediately reverse and try to take out both sides of the candle because there's liquidity on both sides and it wants to take out both sides. And this phenomenon is the most consistent and high win rate setup in my entire strategy. Now, the reason why it's so niche is because it doesn't happen every day. Sometimes we only get it once a week, sometimes maybe 3 or 4 times a month. It's very, very situational, but when you do get this opportunity, it is insanely effective. Okay, let me show you an example. We took this March 11th, so not too long ago. March 11th on the 2-minute time frame. Let's go back and take a look here and we'll go through this together. This is a trade that I took, so there's no hindsight here. I literally made money on this setup specifically. I'm going to break it down and show you how it works. Okay, boom, 2-minute, boom, boom. Okay, boom. Now, all right, here we go, chat. Here we go. All right, cool. So here it is right here. We'll go all the way back in the calendar as well. Here you go. March 11th, what did we have? We had CPI at 8:30 a.m., which is red folder news. So what we're expecting at 8:30, we're expecting a huge, crazy candle. And that is exactly what happened right here. Very erratic. Okay, now, the bigger the wicks, the better the setup is going to be. I just want to emphasize that. Also, let me turn the light on. Okay, just made it a little brighter for you guys. The bigger the wicks, the better the setup is going to be. I've just found that the bigger the wicks, the stronger price wants to actually hit that level. So, you know, this would be a very, very strong draw on liquidity, whereas this little wick is not so strong, but it's still valid regardless. Okay, so what happens next, right? The candle printed. Now we want price to sweep either side. As you can see, price swept the bottom instantly, right? The very next candle, it swept the bottom. Now what happens? Now you mark this top. This is called the data high. And we are basically expecting, you know, maybe not instantly, but hopefully instantly, we are expecting price to reverse and go target this high because of all the liquidity and all of the resting orders sitting there. Okay, so what happened? I went on the 2-minute time frame. Again, you're just going to have to ignore the entry model right now because we're not talking about that just yet. But I found this way to get in. It's entry model. And then, wait, did I go in? Oh, might have got in down here. I think it was down here. Yeah, it was down here. Okay. I got in right here. So I got in long. I got in long right here with the idea that, you know, price should want to reverse and go hit that high. And then what did price do? It reversed and it hit that high, right? So that is it, you know, that is it. And that's a trade that I took with my community. And it's very, very good. It's very, very good. So the whole point is, listen, when we get, you know, have Forex Factory on your computer, when you wake up and you do your morning routine, just take a quick peek, see if we have news, because these types of setups can make you a lot of money. Okay, so that is liquidity in a nutshell. Those are my top 5 liquidity levels that I use on a daily basis. Again, if you want to mark them out manually, you can. And again, over time, it'll just get easier and easier. If you need some help and you want them automatically marked out for you, my indicator does that, okay? But liquidity is super important. I would say if we're looking at my checklist right here, it is the #1 confluence that I want in my trade. It delivers the highest win rate, the best results. And again, we're just going through these confluences one by one, because at the end, I'm going to show you how to put all of these confluences together to actually find trades. But for now, I'm kind of just breaking down what liquidity sweeps are. Okay. I guess the last thing I really want to say is, in terms of liquidity levels, I personally only use 1 hour, 4 hour, and daily timeframes for my liquidity sweeps. Anything lower than that, I do not consider as liquidity sweeps. I know some people out there will use the 15-minute time frame or the 5-minute time frame. That is way too low of a time frame, because like I said before, the higher the time frame, the more liquidity is going to be resting at that level. That is the logic, right? So I'm not going to use a 15-minute time frame. It's not going to be as reliable as a 4-hour liquidity sweep. Does that make sense? Hopefully it does make sense. All right, watch the video a second time if you need to, but that is everything you need to know about liquidity. What is going on, guys? It is the next video, and in today's video, we are going to be talking about premium and discount and the 50% level. So what does this mean? Well, premium and discount is a very, very simple concept, and this helps me understand my bias. Okay. Let me just get to the arrow. Okay. So let's just say this is our range, right? At the top of the range, you want to be shorting. At the bottom of the range, you want to be longing. Okay. This is premium and discount. That's the idea. And the reason is because the way the market moves, it will always come back for retracements, right? When price is in a downtrend, it's going to eventually tap and continue or reverse, right? It's going to make this move down, reverse, up, reverse, down. Okay. No matter what, no matter how much price goes up or down, it eventually will retrace back to this 50% level, which we're going to get into in a little bit. Okay. And that's why we do premium and discount. It's going to keep our bias solid and keep us on the right side of the market. Okay. In very, in very niche scenarios, yes, we will have trend days sometimes where we just keep going up and up and up and up. But if we're playing probabilities, more often than not, we will have a normal day where, we'll go up, right? We will go up, but then eventually price will hit a level, it'll hit an imbalance or something, and then it'll reverse, right? So that's why we want to trade premium and discount. Instead of just constantly taking continuation trades and not knowing, what side of the market I'm supposed to be on, it's just very, very simple. If price is above the 50% level in premium, right? This is premium. I am looking to short. If price is below the 50% level in discount, I am looking to long. Okay, this is how it works. It's very, very simple. Okay, so now there are a few exceptions. I would say 80% of my trades, about 80% of my trades follow this methodology, right? I'm shorting in premium and longing in discount. Very rarely I will do the opposite. And those are more risky trades. They don't have as high of a win rate. So you really want to limit those. And when you gain experience, you'll start to understand when it is appropriate to kind of bend those rules. But if you just stick to this philosophy right here, it will keep you on the right side of the market. Again, we could use some of these, we can use some of these graphs here. You're at the top of the range, you want to short back down to equilibrium. You're at the bottom of the range, you want to long to equilibrium, because price is algorithmically coded to always retrace eventually back to that equilibrium level. And this is just so you're not stuck in no man's land and you're longing all the way at the top of the range when price is actually trying to retrace to equilibrium. Okay. So that is very, very important. Premium and discount, it's one of my confluences. As we're going through our checklist, are you on the right side of premium and discount? And when I'm discussing this checklist, all that means is if you're at the top of the range, are you shorting? If you're at the bottom of the range, are you longing? That in itself is a confluence. Okay. So now we're going to talk about the 50% level, because we're talking about equilibrium. We're talking about this 50% level. What the heck does that mean? Well, the 50% level is the middle of the daily candle. Okay, it's the middle of the daily candle, and that is a super, super, super strong support and resistance level. It is a dynamic level, meaning it will change throughout the day. So if we make a new high of day, it'll change. If we make a new low of day, it will change. So it's a little bit different versus other traditional levels of liquidity that we've spoken about, because those stay the same no matter what. This level will change. That's why my indicator automatically, tracks that for me. So I can show you how to draw this. Okay. I will show you how to draw this, but just keep in mind, my indicator does it for me, so I don't draw this manually anymore. So here we go. Here is the entire day. Now, I like to do this on the 15-minute time frame. And the range or the day starts at 6 p.m. Eastern New York time. Write that down. So the day range starts at 6 p.m. Eastern New York time. So the day starts at 6 p.m. and the range will continue until the market closes at 4 p.m., right? So from 6 p.m. New York time to 4 p.m. the next day. Okay. Now, all you have to do to find the 50% level is you're just finding the high in that range, which is up here. And then you're finding the low in that range, which is down here. And you're just you're taking this rectangle tool on TradingView. You're drawing from high to low. And then if in your settings, if you have it set to middle line, it will automatically mark out this middle line. And then you can draw your 50% level with, whatever tool you want. I like to use this horizontal tool, and then you can just put a little level there so you know where it is. So that's how you manually draw the 50% level. Again, I use an indicator, but it is very, very important. Okay. It is very, very, very important, because what will happen almost every single day is price will tap into this 50% level, bounce off of it. Okay. And that is how we can use our daily bias. You see here, boom, 50% tap, boom, goes long, 50% tap, boom, go short. Because a lot of the times what I'll say with my trading, let me try to find an example here. Give me 1 second. 1 second. I just want to find an example for you guys. A lot of the times, if you're in discount, meaning you're at the bottom of the range, you want to look for a long, and then you're basically targeting the 50% level because that's where price is looking to rebalance to, okay? I'm trying to find an example in my recent trades, but I'm not seeing it. Not seeing it. Oh, I mean, you know, here's an example right here. Here's an example right here. So here's a long that I took. I went long down here. Again, you see this yellow line is above. What does that mean? We're at the bottom of the range. We're in discount. So I want to look for a long down here and aim for the equilibrium, which is the 50% level. In this example, price didn't hit exactly, but it's still a winning trade. So we still made a lot of money on this setup. But if I were, you know, if I were holding runners and I was still looking to catch this move, where would I be targeting? I would be targeting that yellow line. Okay. So that is pretty much everything you need to know about the premium and discount. You know, it's very, very simple. It's probably one of the most simple confluences ever. In terms of the 50% level, again, how you can use premium and discount and your bias is, you know, you can also kind of scalp the 50% level because it's such a huge and aggressive and I guess consistent support and resistance level. When we're in the middle of that range, again, you're expecting price to bounce off. So I would say when you're below the yellow line, you want a long. When you're above the yellow line, you want a short. But if you're right on top of the yellow line, you can actually just look to take a bounce, which is right here. You know, price comes in, boom, bounces, and then you take that long. So that's what your bias would be. You're just looking for a bounce of the level. I have more examples I think that I've taken recently. Let me try to find one here. Go to my Twitter. This is where I post all my trades. Yeah, so here's an example. It's not the best example in the world because you can see up here price chopped around this level a lot, but it did end up respecting the level because we didn't really close above it by a lot of points. We didn't pump above it by a lot of points. We kind of hit it, started consolidating for 10 minutes, and then eventually price bounced off of it. The best type of 50% taps are going to be like the instant ones. I will try to find you an example here, but those are going to be super consistent because price is showing you like this is a really, really nice example here. You know, price hits the low, immediately reverses off of it with great momentum. So this compared to the previous example is just going to have a higher win rate. But you can also, you know, on top of using premium and discount for your bias, you can also scalp longs and shorts as we tap this 50 level throughout the day. So it's a really, really solid level, and I hope you use it. What is going on, guys? We're here to talk about psychology. So some of the videos you've watched so far have been very mechanical, but I'm here to tell you that psychology is one of the most important things when it comes to trading, and it's the make or break for a lot of traders. In my opinion, psychology is more important actually than mechanical. I would say trading or becoming a profitable trader is 70% psychology, 30% mechanical executions. Psychology is so big. It's so big. And until I really mastered my psychology and got it to a place that I liked it to be or where it needed to be, I wasn't seeing consistency. I was seeing payouts early in my trading journey, after those like 12, 13 months that I talked about in this introduction, but I was really never making consistent payouts. You know, I'd get some accounts, get a payout, blow them, and I was just kind of like repeating that cycle, and I would never really grow an account or have streaks until I mastered my psychology. So I have a few topics here that we are going to go over, and this is just my opinion on all these topics, and hopefully, you know, this hits home for some of you guys. So number one, how not to spiral after losing. This one's very, very simple, but a lot of people have trouble with this. How to not spiral after losing. And I've met a lot of traders, especially in the past couple months. They're very, very good when things are going great, but they're terrible when things are going bad. And, you know, I look at their journals and they can win 5, 6, 7 days in a row. They're taking great setups. You know, they understand the strategy. They're doing everything that they need to do. But the second they just face a little bit of adversity, they fold like an omelet. They fold and they just turn into the worst trader you've ever seen, breaking all the rules, ignoring all the process and the steps that they did those other days, and they blow their account just off of one day. And what I've found is that comes from a psychological belief implanted into their brain that you need to win every single day or it's a failure. And that is a fallacy. That's a flaw. Okay. You know, maybe some people, they look on social media and they see these other influencers flex and payouts and all the stuff, and they start to think for themselves, like, if I don't get there, I'm going to feel sorry for myself. But that's just not true. And once you get to that point where you can accept a red day and understand that every single system will have red days, you know, if you go look at a profitable trader's P&L, there's going to have green days and there's going to have red days. But what a profitable trader P&L looks like is either two things. Number one, there's a lot more green days than red days because their win rate is high. Or number two, their green days are much bigger than their red days because of their risk to reward. Those are the two key components that you'll see from a profitable trader's calendar. And, you know, some amazing traders have both, right? Some amazing traders have both. But, you know, you need to just come into the markets and come into this trading thing just expecting like, hey, I'm going to win and I'm going to lose. And it's okay. But I'm either going to win way more than I lose, or my green days will be much bigger than my red days. And if you can just accept that, when that red day eventually does come, it will be much easier to swallow, because you'll sit there in the moment and you'll be like, hey, you know, I won 500 Monday. I won 350 Tuesday. I won 700 Wednesday. Now that I'm red Thursday, maybe I'm red $500. It's okay. I don't need to try to revenge trade and get this money back. I'm still green on the week. You know, if I follow my process and I follow my edge, I'm probably still going to be green on the month. So but that's where a lot of traders get hurt, is because they see that negative 500 on Thursday and they saw that they were green the other 3 days. And then they were like, okay, let me look for one more setup. Let me dip my toes back in. Let me look for one more setup. And that's where that greed gets you, man. That greed gets you. So that's just kind of how it worked for me. I kind of understood that I'm going to lose. Losing's okay, especially if I follow my process. You know, if I lose and I broke all my rules and I took sloppy setups, I'm going to feel annoyed and frustrated with myself. But if I lose taking systematic, high quality setups that I would take any other day, I have no problem closing my charts and just moving on. Okay. And that's what has really helped me become disciplined. And, you know, hopefully that helps you. Let's go into topic number 2, which is going to be base hits versus home runs. What is a base hit? A base hit is just taking a small win, or I guess small is relative, but a base hit is just a nice average small win. Okay. And for me, that is $200 to $300 on a 50K funded account, right? Because although that win might seem small, if you can actually start copy trading and adding leverage, if you copy trade that 10, 20 accounts, it's still a really, really nice day. And if you can consistently take those base hits, they will add up. And at the end of 2-3 weeks, let's just say, you'll be eligible for a massive payout. So that's kind of my philosophy. Now, there are times where I will go for home run trades, which are those, you know, 100+ point moves on NQ, but there's a time and there's a place for that, right? I try to come into the markets with zero expectations every morning, right? I don't predict what the market's going to do. I react to what the market's going to do. All right. So, you know, if I hit a 100-point trade on Monday, obviously it's hype. Everyone's, you know, having a great time. It's super good. You know, it's good for the Discord. It's good for this. But like, whether I take a 100-point trade or whether I take a 20-point trade, my process is exactly the same. And I just know that I don't need to force, going for a 100-point trade, because I've been doing this long enough now that I have the data and the forward testing where it's like, okay, on average, we're going to catch 1 to 2 100-point trades every single week. I can just wait for my opportunity. And that's where a lot of people go wrong. Like I've had people where I've called out a winning trade on stream, like, 30, 40 points. And this dude in the chat will be like, hey, I'm break even, or I'm even red. And I'm like, why are you red? And he's like, oh, I didn't trim at 40 points. I was holding for even more. And it's like, guys, you can't be greedy. You need to trade the chart and not the P&L. Okay. If you're up X amount of points and the chart is telling you that that's a good trimming area, and we'll get into that later, there's going to be a whole trimming video in the course. But if the chart is telling you this is a good area to take profits because of the fundamentals, you need to take profits. It's very simple. You can't just look on social media again and see all these people cherry picking their crazy huge moves, and that's now your expectations for every single trade, because it's not going to work, right? There's going to be days where the market is moving very fast and it's moving a lot of points, and you'll have an opportunity to catch a home run trade. But then there's also going to be those days where the price is very choppy. It's small, it's in a small range. It's not really expanding or moving up or down a whole lot. And that's when you need to adapt and go for base hits. So it's very, very important. And this is experience. There's nothing I can say or do that's really going to allow you to do this immediately, but you are going to have to see when is the appropriate time to do both. Okay. And that is what has helped me extract the most profits possible out of this market. Okay. The next topic I have written down here is revenge trading. I feel like I kind of went over that with the point number 1. So then we're going to talk about maintaining confidence after multiple losses. This is a great point. I'm actually going to bring something up real quick for this. Give me 1 second. And boom. Okay. So we're actually going to have a look here at this. So this is backtested data from my Discord, one of my users. And I think I talked about this in a previous video. But again, over 177 trade sample. On average, this model will have a 76.8% win rate, okay? And again, some months will be better, some months will be worse. I think this month I have an 80% win rate, but then last month in February, it was in the 60s, but it will balance out to the mid 70s after everything's all said and done. So to answer the question, maintaining confidence after multiple losses, not number 1, it's the backtesting. I have the backtesting data to believe, wow, this is unrefutable evidence that someone did, and you can even do this yourself if you want to confirm that conviction that this model works and it's very mechanical, and if I just do the mechanical steps necessary, this should be replicated, because 177 trades is a lot. That's like 8 to 10 months of trading data. And then number 2, but more importantly, I have the forward testing that increases my conviction. I've gone on win streaks with this model. I've traded in front of hundreds of people for a year and proved that this model works. I've helped over 100 people get payouts and get money from this exact model. So I will never lose confidence in this specific strategy with just a bad day here or a bad day here. It's impossible. I would have to lose for weeks straight or a month straight to even consider changing something in my system, because of all the data that I have these past couple of years. And that's what builds my conviction. So, and you have to get there too. It's not going to be instant. I don't expect you watching this video to learn about IFVGs last week and have the same conviction I do, but it will be built over time. The more trades you take that work, you're going to build that confidence. The more trades you see play out in real time, you're going to develop that confidence. And then eventually, if you can get a payout, you will also have that confidence. Even if you make, let's just say you make $10,000 in January from trading, but you go on a dry streak in February, in March, you still have the confidence in the back of your head where you're like, wow, when I got all my shit together and I did this properly, how it was supposed to be, I made $10,000. This stuff works. And that's how you can build conviction and confidence in trading in general. And again, with the multiple losses thing, I would say you need to have a system and stick to that mechanical system. For example, my approach is I have a 2 to 3 loss limit per day, and then I will shut down all my accounts. I know a lot of people out there do the 1 account system. I hate that system. I don't know why you guys do that personally, because there have been so many days where my first trade has been a loss and I've actually ended green, because then my second and third trade are both green. Because again, trading's variance. Anything can happen. If I have a 75% win rate, you have a 25% chance to lose. Your first trade, it could be perfect, it could be amazing. It just loses, you know, it just loses. But for me, I want to let my variance play out as much as possible. And if I can take 2 to 3 attempts where I have a 75% chance to be successful, I feel really good about that than just having one unlucky 75% chance, if that makes sense. So that's personally what I do. You know, after 2 losses, if I'm sitting there and I'm like, okay, I feel emotional, or the price action's not good, I took my 2 chances, let me stop, I just stop for the day. If I don't feel that and I'm like, okay, these were great trades, I'm not really down too much, I'll take 1 more attempt. If that loses, that will be my 3rd bullet, and then I'm done. That's kind of how I quantify what I want to do. And you can't lower your amount after your first loss, because you're messing up the data. You're messing up the data. If you have a 1-to-1 risk reward, meaning, let's just say your stop loss is 20 points, your take profit is 20 points, right? It's very mechanical. You risk $300 every trade. If you lose trade number 1 and you're down 300, what do you need to do to get back to even? You just need to win trade number 2, right? You just need to have a little bit over 50% win rate to be positive and profitable with that approach. But if you lose trade number 1 with $300 and then you cut your risk in half and go 150 on trade number 2, now you're skewing your results. Instead of a 50-something% win rate to be successful, you need even higher, because not only do you need to win trade number 2, you also need to win trade number 3. So I don't like that at all, to be honest. I really, 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 really don't. I haven't seen it be successful with many other traders. And again, that just stems from you lowering your risk, or doing something like that after 1 loss, stems from you not believing in the system and you're lacking confidence. Because if you did believe in the system, you'd understand that every system fails no matter what sometimes, and you still have a very high chance of winning every single trade. So you just wait for another opportunity, take a setup. Every single trade is independent. Just because you lost trade number 1 doesn't mean you should be scared on trade number 2. And you just let the odds play out. That's literally it. That's how I think about it. So that is, we went over a few psychology points. I still have a few more written down here, but we'll put that into another video of the course. So hopefully you guys enjoyed, and click over here for the next video. All right, welcome to psychology video number 2. We have some more topics to go over. All right, number 1 is delayed gratification. Okay, this is a big one. This is a big one, because people on social media, I always reference this point because it's super important, but you look at social media and you see this guy making 10K a month, and you sit there and you're like, man, if I don't hit 10K a month, like, I'm a failure, or I'm doing this all for nothing, or it's a waste. But sometimes you are making progress even if you're not seeing any financial gain. And that's where journaling is really, really important. Okay, I would say for a very large amount of traders, your first year, you should not even be thinking about money. Okay, you should not be thinking about money. You're not going to look at this guy and say, oh man, like, I want to get rich quick and be just like him within 3 months, because that's not reasonable. If you're trying to think like that, it's gambling. You need to learn a skill, and learning a skill takes time, right? When you go to college and you get a degree, that takes 4 years before you even touch a paycheck. 4 years. And for doctors and lawyers, high paying skills, that's even longer than 4 years. So if you really just can't sit there and say like, hey, I'm going to devote everything for this next year, just learn, absorb everything like a sponge, and not expect any profits, this is not for you. And you're really just trying to gamble and try to find something to get rich quick. And you just have the wrong mindset about all of this, to be honest with you. So that's what I would say. Number 1, set your expectations. The first year, just try to, you know, you want to learn as much as information as possible while losing the least amount of money. And again, when we talk about the prop firm video I made, that's how you can do that. You can limit your risk while still having skin in the game and learn and develop your skills. That is what I would do if I had to go all the way back and do it all over again. So delayed gratification. This is also very important when you're journaling. You should definitely journal when you're unprofitable, because you can see improvements in your trading. You know, if month 1 you lose 5,000, but then month 3 you're only losing 2,500, and you're noticing a pattern where you're not losing as much and your win rate's improving, or even, you know, as simple as, hey, 3 months ago I would have done this stupid mistake and I would have taken this trade, but now I know and I've learned from my mistakes and I stayed patient and waited for something better, and that trade actually failed. That is also gratification, you know, that you're getting better. Even though you're not seeing the money in your bank account yet, even though you're not seeing the payouts, you're seeing progress. And that's one of the things that I talked about in my introduction that really helped me keep going, because I think if I didn't understand and see that type of stuff in my trading the first year, I would have quit way before I would have became profitable. But it kept me going, you know. Even if I lost 5K in a month, I would look through my journal and I'm like, damn, like this like 3-4 day stretch, I was doing really good. I mean, I made money, I was trading well. Like if I could just do this more consistently, and that kept me going. That literally kept me going. So again, I would say setting your expectations to something realistic, not thinking this is a get rich quick scheme, because it's not. And then journaling so that you can see your progress and your improvement over time, so that even if you're not getting those payouts right away, you're still seeing results in your efforts. That's super important. Going into my next point is how to manage stress after a loss. Number 1, I want to say that you should not be trading if you feel stressed after a loss. Nothing good is going to happen when your emotions are super high. Your decision-making skills are going to be off, your clarity is going to be off, and you know, you're super prone to tilting and making bad decisions. So if you do feel stressed after taking one loss, you need to just step away. You literally need to just step away, go for a walk, get some air, and either wait until the next trading day or just take a little break and then come back. You know, the stock market's open for, what is that, 7 hours? Yeah, like 7 hours. Yeah, 7 hours, give or take, in a day. So even if, you know, at 10 a.m. you need to take a break and you want to come back during PM, that may be the best decision than continue to trade while you're stressed and emotional. But yeah, again, it just goes back to setting your expectations. You should not be stressed after taking one loss. If you are, then your psychology is just not where it needs to be. You need to understand that losses are completely normal. And it kind of goes into my next point. You are going to get very, very unlucky and very, very lucky in trading. And you cannot let this get you stressed or take you out of your game. And I'll give you a couple examples here. There's a lot of times where, you know, in trading, you set your stop loss, right? You have your stop loss at a certain level or a certain price. And there's going to be times where price is going to come for your stop loss, hit it, and reverse within 1 or 2 points and go straight to your TP. That's going to happen. There is nothing you can do about it. It happens to literally every single trader. But what you can do is control your emotions when that happens. But because there's also going to be times where you have a stop loss, price is going to come within a few points of it, not hit it, and then go straight to your TP. Both of those things are going to happen. It happens to me every single month. And again, it's going to sting really bad. Trust me, 4 years into this, I still feel this emotion. It will sting really bad when that happens, and it'll feel really good when that happens in your favor. But the thing to remember is you are going to get extremely lucky sometimes and extremely unlucky, and you just have to ride the highs and the lows of both of those situations when they occur and not let it get to you too much. You know, I know people where that will happen to them and their stop will get hit by 1 tick or 1 point and it'll immediately reverse to their take profit. and they'll just go off the rails, and they'll, you know, they'll completely just go in a blender and forget about everything they learned, and it never ends well. It never ends well. So that is how I would reply to managing stress. The next thing is not feeling FOMO when price moves a ton, but it wasn't your setup. This is one that beginners struggle with a lot. You know, you'll see that price sometimes will dump, you know, especially during trend days. This is a really big thing where price will dump 300 points, price will pump 400 points. And as a beginner trader, I felt like, you know, I needed to catch every single move, or I wanted to be a part of every single big move. And what that led to is me just taking these like impulsive kind of scalpy trades for no reason. I have no plan or idea about the trade. I'm just simply seeing candles move fast, and my psychology was trying to get that quick dopamine hit. And you know, it may work here and there, and you may get lucky and catch some momentum, but eventually, if you don't have a plan when it comes to trading, you're going to get stuck, and price is going to eventually wick you out. You know, you're going to get hit with a spike, and you're not going to know how to handle it. So this is kind of resolved by, again, having a mechanical approach and having a checklist. This is what helped me. You have a set specific things that need to happen for you to take a trade. And if those things do not happen, it doesn't matter where the market goes. The market can pump 1,000,000 points, dump 1,000,000 points. It doesn't matter. If X, Y, and Z are not present, that is telling me that that trade is not for me. And that's the mindset you need to get into, because that will keep you out of trouble. When price is tempting you with, you know, volatility and up and down and up and down, a checklist will keep you in check, because it's very clear. It is very black and white whether you should be looking for a trade or not. And it's up to you to follow that checklist. So that is how I have pretty much negated all FOMO. If, you know, if I wake up and right off of market open, price dumps 300 points, if there's no checklist for me, if my checklist wasn't lining up with price, then it doesn't really matter. I don't really care. So that is a great point. By the way, all of these questions were given to me by my premium members in the Discord. So I'm getting these questions right from you guys, these psychology tips, and they're really, really good questions. Next one is mentality and building up eval starting from 1 to 5. So this is another good one, another great question. So the power of trading, specifically with prop firms, is copy trading, trading with leverage. You know, it's how you can make 10, 50, even 100K a month. All of this is possible with the power of prop firms. Whereas if you were to use a live account, you know, you would need way more capital, and a lot of people just don't have access to that capital to achieve those type of goals. So what I would say is you need to build it up slowly and steady. Okay, you don't want to go from your first payout with one account and take that money and try to scale up to 20. You're jumping a huge bridge here. You want to do it steadily. I would like to, you know, if I were to do it all over again, I would start with one account, even though it's boring. That's just what I would try to do. Start with one account, try to get a payout on that. That would be about a $2,000 payout on most firms. Use that money, get up to 3 to 5 accounts, try to get a payout on that. Now that's going to be a $8,000 to $10,000 payout, depending on what firm you're using. And then after that, go up to 10 accounts. And then after that, you can even go up to 20 accounts and kind of build my way up to that. So it doesn't feel like it's such a hurdle. Because trust me, if you go from one account to 20 accounts, you are going to subconsciously feel this psychological pressure that is like crushing your shoulders. And clarity and conviction are some of the most important things you need to have when it comes to trading. And if you start hesitating because you're trading 20 accounts and you're not ready for it, it's going to hurt your performance. So that's what I would do if I had to start all over again. Now, for me, another thing is some tips I can give you, like just don't even think about it. For me on Quant Tower, that's the trading software I use. I have one master account, and before the stream or before the market opens, I'll automatically just set all my follower accounts. So in the front end, the process looks the same no matter if I'm trading 5 accounts at once or I'm trading 30. The process looks the same. I have my one master account, and then that's all I'm trading. That's all I see. And then in the back end, it's just copy trading it to all my follower accounts. So that's how you can set it up. Like, another tip I can give you is don't have all your P&Ls of all your accounts posted on your screen at once, because that's going to make you really nervous. You know, you're going to be holding a trade and you're going to be looking at 10 different accounts, P&Ls moving green, red, up 500, back down to 0. And that's going to make you hesitant and like very, very nervous. And you might even get out of the trade before you should. So if possible, you know, only have your master account up. Obviously, you want to have some sort of like order history where you can actually make sure that your accounts were copied correctly. But after that, once you get that confirmation, close all of that. Don't look at all of that. Only look at that one master account and just trade that mechanically, because it can definitely mess with your emotions. Another thing is you could even remove a lot of trading softwares have this. Quant Tower does have this, but you can remove your P&L from the post or from the chart and change it to points. I know TradingView allows this, Quant Tower allows this, maybe Trade8 does, but that's just so, again, you're not staring at that number going up and down, because that's going to make you really, really nervous and emotional. And you should, at the end of the day, you should be trading the chart, not the P&L. So those are just some tips for you and how to kind of build up your copy trading and your prop firm journey. So we have three more tips here. Someone said how not to crash out after missing an A+ trade. It kind of ties into the other point that I was saying about feeling FOMO. And this is just another thing. Like, you're not going to catch every single move, even if it is a good setup. I know that from forward testing and from back testing, with my system specifically, I have about 1 to 3 good opportunities a day where those are high quality setups and I want to risk money on those. So even if I miss one trade that's really, really good and I should have taken it, the chances are there will be another opportunity. And like I said, the market's open 7 hours a day. Just because I miss one setup at 10 a.m., there's no reason to crash out. I still have, you know, the next 6 hours to trade. And if I take another trade later on and I end green, you know, in the future, I'm not even going to remember that even happened. All I'm going to remember is that, wow, that day I ended green. That's it. So there's no reason to just crash out. You are not going to be perfect in trading. You're going to get unlucky. You're going to get lucky. You're going to miss moves. These things are going to happen. But as a trader, the thing you can control is your emotions and just sticking to the system. Okay, that's the best advice I can give you. We got 2 more points here. Holding trades. I'm going to kind of go over this more in the trimming video, so we'll leave that for later. And then the last point right here is detaching yourself from money. This is a big thing, guys. This is a really, really big thing. And I'm going to go on another spiel here. 1 second. Okay, so this is a big spiel. Now, the irony, the paradox of trading is a lot of traders get into trading because they want to make money. But the worst thing you can do is be so invested into the money that it consumes you. The more you care about the money, the worse you're going to do, because you're going to make emotional decisions based on the P&L and not mechanical decisions based on the chart. Okay. And what helped me alleviate this, honestly, is by having income from other areas. I would not try to be a full-time professional trader right away, right off the rip. I think the best way to do it is have side income, whether that's from a business, your job, real estate, some other investment. Have that side income coming in while you're learning and becoming consistent as a trader, so all the pressure isn't on your shoulders to perform. Okay. Because again, you don't have to make a payout by the end of the month no matter what. You know, you don't have to do that. That's what helped me my first year so much. I had real estate, I had an e-commerce business before this, and I was able to sit there and be like, damn, you know, like, I really want trading to work, don't get me wrong, but it's not the end of the world. At the end of the day, I can afford to sit here and not make anything and kind of just learn and soak up information because of that stuff from the outside. So I think that's really, really important. If you can have a full-time job or a part-time job that the hours work with the trading window, that is the best thing to do until you can show yourself and prove to yourself that you can be profitable consistently. So that's just some advice. And then again, detaching yourself from money. not caring about anything, just being like, I don't care about the cars, I don't care about the watches, I don't care about the payouts. I just want to follow a mechanical system and try to trade like a robot, and the money will come after. The money will just flow in naturally after that. That is what really, really, really helped me, detaching yourself from money and falling in love with the process. Okay, so these are some more psychology tips. Hopefully you guys learned a lot. There will probably be more psychology videos in the course, but just click to the next video and I'll see you soon. What is going on, guys? It's your boy Tempo Trades. Today we're coming at you with another video from the course. So this is going to be talking about reactions and momentum. We are going one by one through my checklist, talking about every single aspect and every single confluence of what determines an A+ model or an A+ setup. So at number 5 and number 4, you see reactions and momentum. And you might say, Tempo, what the heck does this mean? Now, I'm going to show you a bunch of examples, and I'm also going to explain what I mean. And it's very important that you listen up, because I would say for reactions and momentum, this is going to be the most discretionary part of the checklist. And again, the model is very mechanical. You know, it's liquidity sweep, reversal, trade, right? But this comes with the most experience, and I would say you just need the most reps. You got to take trades over and over again to really get a feel for this. So what is reactions and momentum? When I say reactions and momentum, what I mean by that is the reaction to the liquidity sweep or the level that we're taking the trade off of, okay? So here's the level. I mean, it can be whatever you want. For this example, we'll just call this London low. You know, just for the sake of the argument, we'll just call this London low. So with this level, the reactions and the momentum to the level are going to tell us the quality of the trade, and the better the reactions, the better the momentum, the more consistent that trade is going to be. And again, that is going to help you in the markets. It's like whether or not to take the trade, whether or not to risk more money on the trade or less money on the trade. So it's very, very important, right? So in an ideal world, what we want is we would want price to come into this level right here, tap this level, and then within just a couple candles, immediately bounce. Let me get a better view here, because you want it to cross the level. You want it to bounce out of that level, and that's when you pair it with your entry model, which in our case is the inverted fair value gap, right? And then you'd go long right here. And then that's, in a nutshell, what our process would look like. And again, this right here would be called good reactions. The reactions is how is price reacting once it sweeps the level? Is it consolidating? Is it, you know, is it dumping past the level a lot? Or is it just simply bouncing right off with very, very good momentum within a few candles? That is going to tell me that my buy, not only is my bias correct, but the move I'm looking for in this entry is going to have a very, very high win rate. Okay. So this screenshot right here is picture perfect. This is the example of good reactions and good momentum. Now, I can show you what bad reactions would look like. Now, bad reactions would be something like this, where price comes down, taps the level, and then keeps selling off a little bit more. Because ideally, you want price to reverse very, very close to the area where it sweeps liquidity. There are examples where price can, like, for example, there are examples where price can come down, sweep this liquidity, and then dump 50 more points. But then when it actually comes up here and inverses this fair value gap, it can still work. But because it took so long to reverse and it didn't reverse instantly at that level, it's showing me that price isn't really respecting that liquidity as good as it can. Does that make sense? Because this is a lot worse and a lot less consistent than if price were to just do this, okay? And it's gonna make sense in a little bit because I'm gonna show you a ton of examples. Now, sometimes if I get something like this, I may not even take the trade anymore. You know, if we sweep liquidity and then price dumps 50 more points below, I might be like, I don't really like this trade enough. The reactions are kind of bad now. We're disrespecting the level. I'm not taking it. So it really just depends on what the other confluences of the trade will look like. But again, Here on the right is an example of good reactions to the liquidity sweep. On the left is an example of bad reactions to a liquidity sweep. And I would say there's no set points number, like there's no set definitive thing that I'm doing. I'm not going to sit there and be like, oh, it has to be 30 points below or above the level and then it's considered bad. I don't have that marker. It's really just a feel thing. It's a volatility thing. It's also the eye test. So that's where experience is going to come into play here. So yeah, this is the example of bad reactions. Now I want to show you the example of good and bad momentum. So here, once again, this is our London low. This is our liquidity level that we're using. So an example of good momentum, right? So let's just say, boom, we have our inverted fair value gap we want to take on the inversion. Bad momentum would be something like this, where, you know, we hit the level and now we're kind of chopping. We're chopping. We're not, you know, we're not hitting. We're not going through the gap. Maybe we're consolidating. And then, boom, we finally inverse the gap. This would be bad momentum because from the point it sweeps to the point we inverse, there's so much time here. And I can even make this look even worse if we do something like this. And then we do this. Like, this is really, really bad momentum. So by the time we inverse this gap, it's just not going to be super high probability that this works. Whereas something that is considered good momentum is going to be what I like to call V-shape, right? So we have the level here. Have the level here. Let me actually remake the level because it's not straight. Have the level here. This is going to be our London low. And then basically price were to come down, tap the level, and then within 1 or 2 candles, just immediately reverse. And then you get that entry model. This is called V-shape, and we're going to go into examples here. So that's the difference between good and bad momentum. You know, whereas good momentum is, boom, we hit the level. Within a couple candles, we immediately bounce off and inverse the gap. Bad momentum, we hit the level, and now for 5, 10, 20 minutes, we're kind of just moving slowly, and we're not really showing that force. That's the difference between a high-quality trade and a low-quality trade. So let's go through some examples here. So we'll move my face cam here. Again, this is considered good momentum. We have our sell-side liquidity level. Price comes into the level within a couple candles. Boom. You see the size of these black candles too. That's really, really important. So boom, right there, we reverse. Boom, IFVG all the way to the upside. This is amazing momentum. Amazing. There are no red candles here. As soon as we hit the sell side liquidity, you can see the shift in bias. 1, 2, 3, 4, 5, 6, 7 green candles in a row. Very, very thick, big green candles. This is considered amazing momentum. We'll look at this next one. Again, this is V-shape. This is V-shape because you can see candle 1, candle 2, candle 3. You can draw a V pattern. This is the best momentum you can possibly get. So when I see this type of momentum, I get super excited. If you compare this type of momentum with some other confluences, you're going to have a very, very high probability trade. So you get the V-shaped momentum right there. That's very, very good. Now, if we look at some examples of bad momentum, this is bad. Now, again, I will preface by saying I'm just cherry picking examples from my Twitter. So you're going to see a lot of wins here. But just because a trade wins doesn't mean it's a good trade or that you should have taken it. You know, you want to take good, high quality trades over bad ones because in the long run, that's going to increase your win rate more. So normally, I would not take this trade, and I just cherry picked an example. But when trades look like this, you don't want to take them. So again, you can see here, look how many candles it takes to reverse the gap versus the previous example I showed you. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles it took to actually inverse that gap. And yes, it did end up working, but that is hindsight. You want to be very, very cautious about these types of trades. And not good momentum. Again, same exact example from up here. This is bad momentum. Now, it is good reactions. It's decent reactions because what you could see here is I have my level, which is 50% of the daily range. price still kind of respected the level. Yes, we did close above the level, but price still stayed within the general vicinity of this level. And if you were to actually go through different time frames, like right here, I'm on the 30-second. If I were to go on the 3-minute, the 5-minute, you can actually see that we wicked it. We wicked the time frame, so it was respected. So the momentum, in this case, the momentum is bad. The reactions are good, which, again, you want both, but sometimes you won't get both, and you just have to decide whether you want to take the trade or not. So this is an example of bad momentum. You could just see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 candles it takes to inverse that gap. And then this is an example of great momentum, just a 3-candle sequence. 1, 2, 3, and it's already inverse. We don't have to wait 10 to 15 candles. This is what you want. This is the beautiful, beautiful pattern that is going to have a very, very high win rate, that V shape right there. And yeah, so I just want to go through some examples here. Again, Twitter, it's not going to be the best resource because I'm only posting like the best trades of the best trades. But so here's an example. Not the best momentum in the gap, but the momentum does get better when I enter. But obviously, this is all hindsight. We don't know when we're deciding whether to take the trade or not. We don't know if the momentum is going to be good after. So we can only judge on what the momentum looks like before the entry, and this momentum's just not the best, right? So I would consider this bad momentum. Let's go to our next trade. This is actually a loss. So we have a level, we come into the level, we sweep the level, we're looking for that reversal pattern. This is decent momentum, like it's bad reactions because again, you see that the level is at 302 and price disrespected the level. We closed under it. We went all the way down to as low as 260. So that means price dumped 40 points below the level. I still would take this because it's on that threshold. If it moved much lower, like 50 points, 70 points below the level, at that point, the liquidity sweep is no longer valid. I would just simply wait for another level to get taken. But this is on the threshold of where it's like, okay, I'll still take it. So I would say this trade, it's bad reactions, but okay momentum because we did have this little V shape or U shape recovery here. And this trade just didn't end up working. So let's find another example. I want to find examples with liquidity sweeps that I can show you. I've already shown you this one. This is good momentum. There's no reactions because there's no liquidity sweep here, but this is pretty good momentum. You can see the strength of these green candles. Very, very fluid. So I would say this is pretty good momentum. It's not the best, but it's pretty good. Let me find something else. So this is good reactions right here. You can see we have the liquidity level and then price doesn't really go past the liquidity level too much. And then the momentum is okay. So this would be considered great reactions, okay momentum, because it does take a good amount of time to inverse this gap from all the way up here. Let's keep going. Let's keep looking at these examples. So this is a great example here. This is an example of amazing reactions. This is A+ reactions because you see we came up to this London high, we swept it, we never closed above the level, and we instantly rejected. This is A+ reactions and really like pretty good momentum too, because you can see as soon as we swept, we just started having red candle, green, red, 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 red until we inversed. You might be asking, isn't this a loss? No, it's not a loss because I put my swing high up here. This was my executions on the trade, so it was a special example, but okay, let's keep going. This is an example of bad reactions, really bad reactions, to be honest. I'm actually shocked they took this one. So yeah, we sweep this level, but then we pump 50 points above the level, and then the momentum's decent. It's not bad, it's not great, it's just average once we sweep that level. I want to show you some good examples because I want to be a good influence. This is great. Good example. This is great reactions, great momentum. Previous day low sweeps. We really don't close below it too much, and we don't dump past this level too much. We bounce off of it. nice thick green candles right here. 1, 2, 3. Very, very nice trade. Very, very nice trade. So you get the idea, guys. And again, this is gonna, you know, require a lot of discretion. Just you taking these trades over and over again, you're gonna start to see how the candles react and manipulate with the levels and the IFVGs, and that's going to determine those two confluences. How good are my reactions? How good are my momentum? Now, again, I will preface by saying, when you look at this checklist, it's a combination. You are combining all of these confluences to determine if you like the trade. Do you like it a lot? Do you not like it a lot? How much do you want to risk? Because if the reactions and the momentum aren't that great, but then all the other confluences are amazing, I'm still going to take the trade. You know, so it depends on the culmination of all the confluences. I could also have the best reactions and momentum in the world. I guess you can't have reactions without the liquidity sweep. So, but you could have the best momentum in the world, but if you don't have any of the other confluences, is it really a great trade, right? So it needs to all be there. And as you watch these videos, hopefully you're starting to understand that, how you can put them together. But yeah, this is just going to require a lot of time and just repetition. Again, this is an example of great reactions and great momentum. You can see within just a couple candles, we bounce right off the level. We don't really dump past the level. And then we get nice thick green candles through the IFVG. A good example here. So that is all I have to talk about when it comes to reactions and momentum, guys. Click on the next video to learn more. I'll see you soon. What is going on, guys? Tempo Trades, we have another video, and in today's video for the course, we're going to be talking about fair value gaps. So what is a fair value gap, and what is an inverted fair value gap more specifically? So in the previous video, if you have not watched it, I would watch it. The liquidity sweeps video, I talk about how in our model, in a nutshell, all we're doing is we're waiting for a high time frame area of liquidity, which we have already went over in the previous video. And then we are just waiting for price to go into this level, boom, bounce out of it, and then take that reversal. This is the whole bread and butter of the setup. Now, how do we know when exactly to get in the trade? And that is where the IFVG comes in. The IFVG is not only our entry model to actually get into the trade, but the IFVG is also the way that we can get really good confirmation that the move that we're looking at is actually a reversal and not a fake out, okay? Because what happens is, if you just try to blindly enter, off of the sweep, like let's just say price was coming down here, and then once it hits your area of interest and it goes up a little bit, you long right here, right? Sometimes that will work, but if you don't get good confirmation, what's going to happen is a lot of the time price is just going to do that, and it's actually a fake out. It's a little pullback, and the market's going to keep going down. So that's why you need some sort of confirmation on top of the liquidity sweep, on top of everything else, to make sure it's actually a valid reversal. And that's where the IFVG comes in. It's a really good entry model, and I've been using it for, I think, coming up on 3 years now. It's coming up on 3 years now, but it's just such a good entry model. So let's go into it now. Very beginner level, what a fair value gap is. If you have not already, I would also just go into YouTube and just type in what's a fair value gap, because it's super beginner, super basic. But basically it is a gap between a 3 candle pattern. So if I look on the chart here, you can even see right here. I'll turn off my indicator so you can see it a little clearly. But here is candle number 1. This candle right here is candle number 1. Here is candle number 2. And then here is candle number 3, right? So you have these 3 red candles. Now the gap between candle 1 and candle 3 is your fair value gap. And you can see that right here, right? You can see there's the gap from this wick right here to this wick right here. That is your fair value gap. Okay, that is an imbalance of price, where price is going to want to oftentimes retrace back into it and reject. But when we have our liquidity sweep and we have our confluences, that's where we make money, because we're actually predicting the fair value gap to break. Okay. And another thing I want to talk about is, you know, the IFVG is good to time the reversal, because I would say in a normal bearish trend, let me try to draw it. I don't even know if I'll be able to draw it, but here. Yeah, so in a normal bearish trend, like, this is what price is going to look like. It's going to come down, go up, tap into a fair value gap, go back down, tap into a fair value gap, go back down, tap into a fair value gap. Like, this is what a normal bearish trend will look like. It's very, very rare that a trend just goes straight down with zero pullbacks. That's not how it works. A lot of the times it's going to look like this on the left here. So this is what a normal bearish trend happens. Well, if at the bottom of the bearish trend we can sweep liquidity again with any of the levels that we spoke about in the other video, we can actually get an idea and time the exact moment when price is going to change the trend from bearish to bullish. And again, that has to do with the fair value gap. So again, if we were respecting the fair value gap here, respecting the fair value gap here, respecting the fair value gap here, but then all the way at the bottom, we sweep liquidity, and now, right, this final fair value gap that we just created, if price actually bounces off the level and inverses the gap and doesn't respect, that is where we make our money. Now we have edge, and we have a really, really good idea that this is the exact moment or area in price where it is not going to respect the fair value gap, and price is actually changing its trend and we're going higher. That is the whole basis and philosophy of the model. Okay, the inverted fair value gap. If you can pair all of the other confluences we have spoken about, liquidity sweeps, premium and discount, momentum, everything, and then you can just pair that with a IFVG, that is where the magic happens. Okay, so basically very, very simple. Very, very simple here. All you want to do, so again, we're going to make this very, very basic. Here's our level. I'm just going to keep marking this London low. Very, very basic, right? So here's what our setup looks like in a nutshell. Price will come down, tap into the level. Again, we're expecting good reactions and good momentum, like we spoke about in the previous video. So we want price to reverse and bounce off this level within a few candles. Then you are going to drop down to the lower time frame, either the 30-second, 1 minute, 2 minute, or 3 minute. We'll talk about that in a little bit, but let's just say for now we're on the 1 minute. You identify a IFVG or a fair value gap. Once price closes a full candle closure above the fair value gap, that now goes from a fair value gap to an inverted fair value gap, and that's where you would enter long right here, and then your stop loss would be underneath the fair value gap, and then again you're just targeting up there in the range. So in another video we'll talk about stop losses more in depth. In another video we'll talk more about trimming and how to take profits more in depth. For now it's all about fair value gaps. So this is the general basis of the system. You are literally just waiting. After you get all of the other confluences, you are literally just going on your time frames, trying to find a fair value gap, waiting for that fair value gap to get inverted, and then you're entering your position. That's how it works. Because logically speaking, the inverted fair value gap is the final confirmation in the system that the trend is changing from either bearish to bullish or bullish to bearish. That is why we wait for that, because again, you're just more prone to fake outs. If you just simply enter long down here before the inverted fair value gap confirmation, you're going to get hit with a lot more fake outs because price is going to just keep dumping through the level. So yeah, that is in a nutshell. I have a few notes written down here. First of all, the best sizes for a fair IFVG. This is a great question. It's something I get a lot. I would say the best, I want to use this as an example. We can just look at current price and talk. I would say the best sizes for a fair value gap is going to be 8 to 15 points on average. Now, that is going to change based on volatility and context. In completely normal conditions, 8 to 15 points, maybe even bump that up to 20. That's like the ideal size that I want. But if we're in extremely volatile conditions and price is moving super fast, or maybe, you know, Trump tweeted something and the market's spiking, you're going to have to double that. And it's going to go from 15 to 30 points, because the size of the gap and what I'm looking for is completely dependent on the volatility of the candles and how large they are, right? You know, so you want a decent amount of support for your IFVG. And I can show you an example here. So let's use this example right here. Boom. So we're on the 1 minute time frame. You see this IFVG right here. My indicator's also marking it. So the reason, even though this trade worked, I don't care. I'm not a hindsight trader. I don't think like that. The reason this fair value gap is pretty poor is because, number one, if you could see on the right, it is only 6 points. And number two, the size of this fair value gap is way smaller than all of these candles, right? So the gap is only 6 points, but the size of the look at the size of the candles. This candle's 24 points. This candle's 26 points. This red candle is 25 points. So if all of the candles are 3 to 4 times larger than the fair value gap, what do you think's going to happen? If we close underneath the gap and you enter short, but then price actually wants to come back and retest, a lot of the times, because of the volatility, the price is going to slam through the candle and keep going higher like it's not even there. And you're going to get stopped out really quickly. So in this example, I'd want a bigger gap. You know, I'd want a gap like that big, to where, you know, it feels way better that with the size of the candles, I'm not just going to get stopped out instantly. Okay. I want to try to find a better example here. This is a better example, you know, and again, I'm not cherry picking wins and losses. I'm just specifically showing you gaps so you can get an idea. This, let me turn the indicator off. This is a much better example of a gap. So this gap right here is 13 points, right? The size of the candles, I guess I could find a better example. I think I like it because of the momentum pretty much, but let me go back here. I want to find a good example, a really, really good example for you guys. Honestly, today's price action was not the best, so I may be looking in the wrong range here. This looks pretty good too. This gap looks pretty good. But, you know, I'm not taking a setup just because of a fair value gap. I have to have other confluences with it. Just keep that in mind. So this gap is 26 points. The size of the candles, 34 points, 18 points, 27 points. So yeah, this gap I like a lot more. I feel like, okay, if I were actually to take this long when price closes above the gap, it's not just going to stop me out in case the first candle is bearish. You know, there's a chance where price could retrace into this gap. It will hold, bounce out, and then my play will continue running to the upside. So like, that's very, very important. You know, if all of the candles are 20 to 30 points, there in no way am I ever going to take a 3-point IFVG. It's just too small. It doesn't make sense. So yeah, I would say normally 8 to 15 point gaps are good. When price is volatile, you can do 15 to 30 point gaps are good. But then how do I word this? So in general, the context and volatility of the candles matter. Okay. So, and that's, again, a little bit of discretion is going to be needed for this, because I've seen these fair value gaps so many times. I kind of have a good feel of like, okay, what's a high quality fair value gap and what's a low quality fair value gap? Is this going to have a great chance of working? Is this not going to have a great chance of working? So that is just the general baseline foundation. But you know, if someone DMs me and they're like, hey Tempo, why did this trade work, or why did this trade fail, you can have all the other confluences in the world that we've spoken about. You could have the liquidity sweep, you could have the momentum, the reactions. If you're only taking a 2-point fair value gap, or you're taking a shitty gap, that is going to make or break the trade. I'm telling you, it's one of the most important things. You need to make sure you're taking good fair value gaps. Okay. Next thing we want to talk about is scrolling through time frames. I don't know. I could use this as an example. I can actually use the trade I took today as an example. Okay, so let's go all the way back here. This is a trade I literally took today. So really good learning moment here. So let's just say we wanted to take on the 30-second. Let me turn my indicator on. I just need to check something real quick. Right here. Okay. Yeah, it is this right here. Boom. All right, so we are going to talk about the fair value gaps. So as you can see, not quite sure why the indicator isn't marking it, but I think it might be a little glitched in replay mode. Okay, we have one fair value gap right here, and then we have one fair value gap up here that my indicator is marking. Okay, so there's something called singular fair value gaps. Okay, and it is the idea that the main reason why fair value gaps fail is because of other fair value gaps. A lot of the time what you'll see is if you wait for this fair value gap to inverse and you enter long here, if price has to hit another fair value gap, a lot of the time what's going to happen is boom, and then it goes up, hits this fair value gap, and then rejects. Okay, that is one of the main things that make this system fail, is other fair value gaps. So what we like to look for is singular fair value gaps. Those are going to be the best high quality fair value gaps out there. So you want to combine the size, which is what we just talked about, the best size, and you want to find the singular fair value gap. Okay, and what that means is it doesn't have any other fair value gaps in its way until you either take profit or you at least move your stops to break even. So for an example, if we were to just use the higher fair value gap, right, there are no other fair value gaps here until all the way up here. Do you see that? Right? There are no other fair value gaps on this specific time frame than all the way up there. So this is a good fair value gap. You would enter long when price closes above. And it doesn't matter if there's a fair value gap up here, because by the time price hits that higher fair value gap, you're going to be up 70 points. So you are going to be very heavily in profit and already taking partials. So even if you're holding a runner and price does come up here and tap this and then come back down, it doesn't matter. Okay, so that's very important. Singular fair value gaps are going to have a much higher win rate. Okay, so now the other thing I want to talk about is called cycling through time frames, and this is how you can find the best fair value gaps possible. So in other strategies that I used to trade, they specialized in one time frame only, and okay, never mind, I was reading something. So they're specialized for one time frame only, and we don't do that. I use the 30-second, I use the 1 minute, I use the 2 minute, and the 3 minute to actually get in my trades. Now, the other time frames you might be asking, the 5 minute, the 15 minute, the hourly, the 4 hour, those are only used for bias. I'm very rarely actually getting in a trade on those time frames. Okay, so what I like to do is, let's just say for argument's sake, we have a liquidity sweep here, and now I want to look for a long and I want to look for a trade. What I would do is I would go through all my different time frames. I would look at the 30-second, I would look at the 1 minute, and so on and so forth, and kind of judge and analyze and be like, oh, okay, you know, there's a 3 minute gap here, but it's only 13 points. That might be kind of small based on the context. oh, then we have a 1 minute gap here, and this is 22 points. That's way better. I'm going to go on the 1 minute time frame. And that's kind of how I decide which time frame I'm going to use. It's based on discretion at that point. You know, you need to pick which time frame you like the best, depending on size, singularity, all that stuff. Okay. Am I missing any other points? Scrolling through time frames, singular gaps. You know, I will take singular gaps very rarely, but I mean, if you just go to my Twitter, let's just go to my Twitter here and look at some of the trades I've taken recently. Mostly all of these gaps are going to be singular. I mean, you see this short right here, singular. There's no fair value gaps down here. This gap right here, singular. No fair value gaps above me to worry about. This is a rare example because it wasn't singular. As you can see, there's a fair value gap here, and then there's also a fair value gap here. So this play would be quantified as riskier than normal. This one right here, no fair value gaps above. It is completely singular, right? So that's just the idea. You want to pick a good size fair value gap based on the volatility and context of the market, and you also want to make sure it's singular if possible. Okay, there are going to be times where you're scrolling through all the time frames and there is no singular gaps, and at that point you have to make a decision. Based on the other confluences, do you like the trade enough to actually take it knowing that it's not singular, or do you think you can wait for something else that's better? Okay, another thing I want to talk about, let me refresh my page right here. Another thing I want to talk about is combining gaps. You can actually combine fair value gaps to find a good setup. So for an example, I will show you right here. Okay. Wait, it's down. Is it not down here? Give me 1 second, chat. I'm trying to find where I was. Oh. Interesting. I'm just looking at something right here. Oh. Oh, that can't be right. It's got to be this, right? Oh, is this wrong? Okay, that's why it was tripping me out. Okay. All right, this is the point I wanted to make. So, if we have two fair value gaps right here, because here's fair value gap number 1, okay? Here's fair value gap number 1, and here's fair value gap number 2, okay? You can clearly see that. Here's fair value gap number 1. Here's fair value gap number 2, okay? So there's two fair value gaps very, very close to each other, and I'm going to shut the indicator off so you can see. So what's going on here, okay? Number 1, this fair value gap below is not really good because it's what we spoke about earlier. If you take this fair value gap long, you are going to be going right into this higher fair value gap, which means it's not singular, which is not good, which we talked about. But the higher fair value gap, which is singular, is kind of small, you know? It's kind of small. I'm gonna size it up right here. It's only 9 points. It is within the vicinity of the 8 to 15 point range, but when I'm looking at the volatility here and how big these candles are, in my opinion, it's a little small. You could just take that one gap by itself, but because it's on the small side, I want to try to do something else. And what you can do is you can actually combine the fair value gaps. If two fair value gaps are in very close vicinity to each other, you can combine them as one complete imbalance, okay? So what I would do here is instead of separating them like that, I would simply just draw the higher fair value gap down to the lower fair value gap, and then this combined fair value gap is what we can use, and then you can enter long and put your stop below the gap like so, all right? So that is another tip that you can do. Now, you want to make sure that they are in close vicinity with each other, because for an example, let me try to find an example here. Like, I'm just trying to find an example, but if you wanted to use this fair value gap up here and then this fair value gap down here, now this is way too far, okay? This is way too far, because if you were to combine the two, your stop loss on this trade is going to be 60 points, and that just doesn't make sense. It just doesn't make sense. and you see how big the gap of price from fair value gap 1 to fair value gap 2 is, it just doesn't make sense. You can't do this. The only time you can really combine the gaps is like this, when the gap between fair value gap 1 and 2 is just really, really small, right? I mean, look at the gap here. The gap is way smaller than the other one, which I was showing you. So that's just something to keep in mind. And I think that is pretty much it in terms of fair value gaps. Again, size matters, context matters, volatility matters, and singularity matters. Singularity matters, okay? If you can do that, again, it's repetition. If you're coming from a different strategy where you only sat on the 1 minute time frame, it's going to be a little bit of an adjustment. But again, what I like to do is cycling. If I have a level marked out and I'm waiting for that level to get tapped, as soon as we sweep that level, like down here, I'm automatically going through all my time frames: 30 second, 1 minute, 2 minute, 3 minute. What's the best gap? What do I like? And then, you know, you act. So that is everything about IFVGs in a nutshell. They are absolutely amazing. You should try them. All right, guys, in this video, we're going to be talking about stop losses, and stop losses are super important because obviously you're going to lose no matter what in any model you trade. So you're going to have to properly know how to lose and size for a loss so you can be successful. So you really have three main ways to use a stop loss with this model. Number one would be a hard stop. Number two would be a soft stop. And then number three would be a hard stop, swing low or swing high. So these are really your three options. And again, there is no right answer. The thing with the IFVG model, what you'll find is you don't have to trade exactly like me or anyone else. With the stuff that I'm teaching you, you can add your own twist to the model and be very, very successful. So my opinion, you should watch the free course, watch the whole thing, take everything into account, you know, tweak and test things in the system. And then if you want to change stuff up, you can. The great part about it is we can all trade the same model with IFVGs and all be profitable, trading it slightly differently. You know, it needs to make sense for your personality and your psychology, more importantly. So for me, I personally use option number two the most, which is the soft stop, which we'll get into. But I know some people who just can't do this at all, and they have to use a hard stop. So either option one or option three. So, all right, let's get into it. Okay, so we'll go back to our example, right? We have our level right here. You have our level, which is London low. Okay, so let's just say price comes down, sweeps London low. You identify a 1 minute fair value gap. So you're like, okay, if price were to bounce off and close over the gap, I will enter long. Now, you're going to sit there and say, where do you place your stop loss? So you have two options. Number one, or three options. Number one, you can put a hard stop loss underneath the fair value gap. That's the most common, I guess, route people go. You're just putting it under the gap. Option number two, below the swing high or the swing low. So you'd find the swing point or a swing point. It could be the lowest swing point, or maybe we put in another swing point in this leg, but you're just finding a swing high or a swing low where you feel comfortable putting that stop loss. And then option number two is your soft stop loss. So what this means is you're hopefully waiting for a candle closure below the gap. Okay, and the benefit of the soft stop loss is you're not going to get faked out by wicks. Okay, I used to be in another community back in the day. This is a couple of years ago, but he always used to say, wicks do the damage, bodies tell the story. And it's very true, because there's a lot of times where price you'll enter here long, and then price may retrace a little bit and even wick here, but it doesn't close. It's just going to wick for a second or a couple seconds, and then eventually the play will work. And the thing is, if you had a hard stop loss here, your hard stop loss would have gotten hit, whereas your soft stop loss, if you were actually waiting for a candle closure, you would have stayed in and the trade would have been a winner. So this does take experience, because like there's a fine line between waiting for a candle closure and then just FOMOing and holding on to a position that you shouldn't be and taking too much loss. Because again, with the hard stop loss, the benefit, there's pros and cons to every single method. That's why there's not just one surefire method. The pros to the hard stop loss is you have a fixed stop loss amount no matter what, and you are going to know exactly how much you lose. Because obviously if you get into the trade and then you drag your stop loss to that level, it's going to tell you, right? Whereas the con of the hard stop loss is you are prone to getting faked out by wicks, because if price wicks it and doesn't close and bounces right back up, you just got faked out. So that's the pros and the cons. The pros to the soft stop loss is obviously you can save yourself from a couple losses by not getting wicked out. But then the cons are, number one, you're never going to know the exact dollar amount you're risking. You are just going to have a general estimation because, you know, if you do get out here, I mean, it can close here, it could close here, it could close here. So you have a general estimation of what you're going to lose. And at the same time, the con is if you're not good at this method, you are going to be prone to losing a lot more money. You know, like if you're trying to risk $300 on a trade and you end up losing $700-800, that's a problem. It shouldn't be more than double. That's a problem. That means you're either holding too long when you shouldn't be in the trade anymore, or B, you're not fast enough and you're not reacting enough and you're hesitating. Okay, so that is the stop loss that I use. Here's kind of an example, not really, but you could see I enter long here, and this wick, if it would have wicked just a little lower, a lot of people's hard stop loss who had their stop loss under the gap, that would have gotten hit, but my stop loss wouldn't have, because again, there's no candle closure. A real candle closure for a stop loss would look something like this, right here. So I would be getting out on this black candle right here when price actually closes under the gap. But if price just wicked, I would try to wait a couple more seconds. Now, there's one more caveat to the soft stop loss. Obviously, this would be called, let me clean this up a little bit. So this would be called your stop loss zone, right? So this is called, these are two terms to talk about here. This is the ideal entry zone, and this is the ideal stop loss zone. And what does that mean? All that means is, in a perfect world, if you got a perfect close above or a perfect close below, this is the area that you want to be in, because it is right above the gap and it's right below the gap. So that's your ideal entry areas. So if I'm doing a stop loss, ideally I want to exit somewhere around here. Okay. If, let's just say, for whatever reason, price, I enter long there, price rejects, and now it's in my stop loss zone, but the candle hasn't closed yet. This is where you need to make a discretionary decision, because there's 30 seconds left in the candle, but price is already in your ideal stop loss zone. Now here's where you make a decision. Based on all of the confluences and how the trade looks, do I want to give this a little bit more room and maybe wait a few more seconds and see what this does? Maybe it will wick out of this area and continue higher. Or does the trade now not look as good as it did before? And this is probably, just based on my experience and my feeling, this is probably going to be a loss. And that means if it just goes a little bit below my stop loss zone, even if it doesn't close, I'm just going to get out. I'm just going to get out. And that's, again, the decision you need to make. So, sorry, very tired today. But, you know, that's a decision you need to make. If price is below my stop loss zone and there's only 10 seconds left, for example, and this trade still looks pretty decent, I may try to hold for a couple more seconds or even try to hold for the candle closure. But if price is all the way down at my stop loss zone and there's a whole minute left on the candle, I just can't justify holding that very closely, and I'm probably just going to get out once it dumps somewhere in this area. Okay, because again, so much can happen in a minute. If I actually wait the entire minute, I mean, price could be all the way down here by the time that happens if it's really dumping hard. So you just don't have the luxury of waiting for that long. So again, with a soft stop, you're either A, getting out when it actually closes above or below, which invalidates the IFVG, or B, you're just making a decision, and once it gets below your stop loss zone a little bit, depending on the trade and depending how much time's left, you just get out. Okay, so that is how I use my stop loss. And again, you need to basically figure out what works for your psychology. I know a lot of people, they're just too emotional, they're too finicky, and they want it to be super mechanical, so they just use hard stops, and if they get faked out, they get faked out. It doesn't matter, it's fine. But they don't want to have the stress of having to think about all these other decisions with the soft stop. So that's completely fine. That can work. For me, I don't mind managing my trade a little bit more and using the soft stop because it does help me a few times a month from losses. And that's just why I do it. But overall, these are the stop loss areas and how to use the stop loss for the strategy. You know, once you have the IFVG and it closes above, that's when the IFVG gets created. But if price ever comes back down and closes back under that gap, that's when the IFVG is invalidated, and that means your trade, you should no longer be in the trade. As simple as that. So hopefully this helps. See you next time. Welcome back, guys. In this video, we are going to be talking about pretty much the final confluence here that I use in my system, which is going to be SMT Divergence. This is not on the checklist, but it is something I use pretty regularly. And this is probably one of the things new people or new traders struggle with the most. So SMT is very, very simple. It is the belief that if you look at my screen right here, okay, you have NQ and you have ES. These are both called indices. So because they are both indices, they should correlate with each other. If NQ goes up, ES should go up. If NQ goes down, ES should go down. That is how it will traditionally work. Now, there are going to be specific times where you see this divergence, meaning ES and NQ are not correlating, and that can give you a hint of where the market is going to go, okay? And that is called the SMT divergence, and that's how you help you find setups, basically. So, for an example, let's say, I'm really bad at drawing, but let's say we have a swing high right here, and then NQ sweeps that high, but then we have a swing high right here on ES, and ES doesn't sweep that high, right? So let me draw that a little bit better. Is there an eraser? There's no eraser for that? Okay, interesting. Let me just draw that a little bit better. Boom. And then boom. Okay. So this is called the SMT divergence. If one of them sweeps the high, but the other one does not sweep the high. Now, just very, very clearly, if the SMT is on the top, it is called bearish SMT. If SMT is on the bottom, it is bullish SMT. Just very, very simple. Okay. So this would be a bearish SMT because it's on the top. So what does this mean? Because there's a bearish SMT and there is now divergence, that is a bearish confluence. Okay. Giving you a hint that the market structure might shift the other way. Right. So if you are using this, right, if you were using this and you already wanted to take shorts and you saw a fair value gap here, now it's even better time to where if price were to retrace and come back down, that is an added confluence to go short because you have that bearish SMT at the top. Okay, that is all. That's literally it. SMT is very, very simple. So I'm going to show you an example here. Here's an example of a trade I took with a bearish SMT at the top. Now we're going to hop into the charts and show you what I mean. So as you can see right here, let me just zoom in even more. As you can see right here, price is in an uptrend, right? You can see very, very clearly that price is in an uptrend. And we need some sort of confluence or signal to tell us that price is going to finish that uptrend and the trend is going to reverse. And that's where the SMT comes in. So you can see right here, very clearly, we have the swing high at 10:20 a.m. And then on ES, we have the swing high at 10:20 a.m. Now, I also want to clarify for the SMT, you're looking for the same exact times, you know, on NQ and ES. So you're not going to be like, oh, it swept this high at 10:20, but then on ES, it swept this high at 10:25. It has to be the same candle at the same time, right? They got to correlate. So you could see really very clearly, NQ did not sweep this high, but then if we go to the same exact high on ES, it did sweep this high. That's a bearish signal telling us that the market may flip. And this is how you draw it. You just take the trend line tool, you go from the high to the other high, and then same thing on the other one, you go from the high to the other high, and that is how you mark the SMT. Now, obviously, if NQ were to come and take this high, that SMT would break, and now the SMT is no longer valid. But as long as this divergence is there, and one of them sweeps the high and the other one doesn't, the SMT is valid, and this would just give me a bigger incentive to look short for that reversal. And then as you can see, I mean, if we just take these fair value gaps, this cluster, you know, you enter short when we inverse this gap. See, boom. So you enter short right there. And this one works pretty nicely. I mean, very, very nicely. So goes all the way down here. So that you could see the SMT actually helping you and giving you a clear indication of when that trend is going to change. So that's why SMT is super, super powerful. Now, I don't need SMT every single trade. That's why it's really not on this list. I would say this list has the most important confluences out there, but the SMT is like the cherry on top. You know, if I'm already looking for shorts and I'm already bearish and I'm just waiting for a setup, if price puts in an SMT that's in my favor, boom, that's just like, wow, like, holy shit, I want to take this trade even more. And then we can look through some examples here because I did a class a while ago with some examples. Let me see. So here's another good example right here. This is from a stream. So you could see on the right, these red lines are hourly. No, these are the London high and the Asia high. So the London high is in red. The Asia high is in blue, right? So you could see very clearly ES on the right sweeps the red line. NQ does not sweep the red line. That is bearish divergence. So now, if price were starting to look to turn around and start dumping, that is an added incentive to be like, holy shit, you should probably look bearish here. That SMT is at the top now, okay? And you could see price sold off pretty nicely. Here's another example. As you could see, compare the left to the right. It's very, very obvious. Here's another example. This one's a little smaller. I'm just drawing it from candle to candle, but you could just see the difference from the left to the right. Here's another example on the bottom. You could see NQ sweeps this candle right here, but then on the same exact candle, ES does not sweep. So there's some bullish divergence. See, it's on the bottom now. Because it's on the bottom, the SMT is bullish. When the SMT is at the top, it is bearish, right? So here's a bullish example. This is another bullish example right here. Yep. Bullish example right there. And then I have to go earlier into the video to show you the bearish example. Here's the bearish example here because it's on the top, right? It's on the top. Okay. So yeah, it's not loading right now, but it's just very, very simple. It's all about swing highs and swing lows. And SMT is a great confluence to have. It's one of the best confluences just to kind of complement whatever you're doing or whatever bias you have. So that's what I would say. And I probably use it like 20-30% of the time. All right. What is going on, guys? Tempo Trades. We are going to be doing a 2026 updated trimming video. So this one might be really, really long. Sit tight and relax. This is one of the most crucial, this is one of the most crucial things for the model. So we're going to go over this in detail. Okay. So let's start. It's going to be more of a chilled video. So lay back and relax. Maybe grab a snack. All right. So here are the 3 most common trimming methods with my strategy. Okay. You do a 1-to-1 fixed risk to reward, 1-to-2 risk to reward, or partials, which is what I personally do. To be honest, I would say like 80% of the time I do partials, meaning, you know, you're trimming half, holding the rest. And then in situational elements, I will do a 1-to-1 or a 1-to-2. When I talk about situational, it would mean, you know, let's just say there's periods of chop or there's periods of slow price action. If I don't think that there's a chance that price can continue going in my direction, you know, like a slow day or no news Monday or just something like that, I would just be like, you know what, I'm just going to go for like a 1-to-1, go for a base hit, move on to tomorrow. So that's like a situation where I wouldn't take partials. Okay. So now let's just look at the raw data here. This is data that one of my Discord members collected in 2025 with over 177 trades with my system. And what did they find? They found that my system has a 77% win rate, 80% win rate with a 1-to-1, 63% win rate with a 1-to-2, 45% win rate with a 1-to-3. So the point of this is no matter what trimming method you select, all of these are going to be profitable if you execute it the right way. You know, you can get payouts doing a 1-to-1, you can get payouts doing partials. Your objective is you need to find which of these systematic approaches fits your personality. Okay. I've met with some students and they understand the model, they understand the strategy and how to trade, but just because of their personality and their psychology, they have trouble holding partials. You know, they always trim too early, they get nervous mid-trade, they touch their position, and it hurts them. Whereas if they just did something a little bit more mechanical, like a 1-to-1, it actually works much better for them in the long term. So through trial and error, you got to figure out which one of these you are going to do. And yeah, so let's go over all of them real quick. 1-to-1, pretty simple. You are just aiming for exactly what you're risking. So this would all just depend on the fair value gap. You know, let's just say here's the fair value gap you're inversing. I'm on the daily time frame. Let's drop down here. Okay, so this is better. So let's just say here's the fair value gap you're inversing, right? You have about a 15-point stop. So what would you do? You would just set your TP to about 15 points. So it's all going to depend on what your stop loss is. That is what's going to tell you how much you need to be targeting to get a 1-to-1. 1-to-2, pretty much self-explanatory. Same thing. You just move this to the 1-to-2 depending on what your stop loss is. Now, another thing with the 1-to-1 or with the 1-to-2, 1-to-2 is great. 1-to-2 RR works very, very well, and it's very, very profitable. But you guys have to watch out during times of chop and low probability conditions, because there's going to be days in the future where we have a very tight range. Maybe price only moves 60, 80 points. And on those specific days, it's going to be really, really hard to get a 1-to-2 because the nature of price is just, it's not expanding. You know, some days on the higher time frame, you're going to have big bullish or bearish candles. Some days you're going to have small little, you know, inside consolidation candles. So if you do want to do a 1-to-2 RR with trimming, you need to get good with the ability of identifying poor probability conditions and then temporarily switching to a 1-to-1 just until those conditions clear up, or, you know, maybe the next day or whatever have you. Because Again, if you try a 1 to 2 on days that price is not expanding, you're gonna get killed. So just keep that in mind. Yeah, so that pretty much goes over the fixed RR. If we just take a look at partials here, so here's what I like to do for partials. Again, it's very situational, just depending on what is price action doing, how volatile is it. A little bit of experience comes into play, but I will give you like a general baseline foundation of what I like to do. So I'm just going to use 10 micros as an example. It's a nice, easy round number. So 10 micros as an example, okay? So now, for my first trim, let's just say this is the trade. For my first trim, I like to trim anywhere from 15 to 25 points. And that just depends on a multitude of factors. You know, that depends on swing highs or lows, depends on fair value gaps in the area, depends on points, depends on momentum, right? So these 4 things determine where I look to take my first trim. You know, if there's a perfect, let's just say right here, there's a perfect swing high right at 20 points. And maybe we're even hitting like a higher fair value gap right here. That is a perfect area to take your first trim and then hold runners, right? I don't really like to trim anywhere below 10 points. It's just too tight for me. Maybe in very, very niche scenarios when price is slow or unfavorable, I'll take a trim just because I want to catch something. But 90% of the time, I am not trimming under 10 points. I always like to trim in the 15 to 25 point range. And that just depends on these factors right here. You know, is the momentum good? If so, maybe I hold for a bigger target. If it's not good, maybe I trim a little earlier. FVGs, you know, are we hitting any fair value gaps close by? If so, I might want to trim as we're hitting them. Same thing with the swing highs and the swing lows. So yeah, that goes for partials. In terms of like sizing, so again, I like to use 10 micros as an example. I usually like to trim 30. It's super dynamic, to be honest. I mean, it could go all the way as low as 30% trim, and then it can go all the way up as like a 70% trim if I'm doing partials. Again, it just really depends on, do I like the trade? Are there obstacles in the trade that I'm afraid of? In that case, I'm going to trim more. You know, if I love the trade and I think it's an A+ setup and it has a really good chance of hitting all the other drawn liquidities above, I'm going to trim less. Whereas if there's a lot of negative factors that I'm scared of, I'm going to trim more. And again, that just comes with experience. Sometimes I do say it on stream as well, like you should be trimming this amount or this amount. So you'll get better with that as time goes on. And you're never going to be perfect. Like, you're never going to be perfect with partials. That's just the nature of the beast. You have to be okay with like leaving money on the table. You know, here's a perfect example, right? Like, even if 2 trades in a row, right? Let's just say here, 2 trades in a row, you know, price comes up, hits this level, you take off 5 micros, now you're holding 5 more, and then it comes back to break even. You're sitting there like, damn, I had 5 micros that I didn't even take profits on. I should have trimmed more. You can't think like that. That's hindsight. Because if you just keep holding partials every single week with this method, we catch great trades like this. The one time you catch a huge banger like this, those runners are going to pay dividends. So you just got to stick mechanically and not, you know, focus too much on what happens every single trade. But yeah, so I'm not even going to take this, but this is a crazy good setup. I don't really trade Asia, but I'm actually on the chart right now, so I'll keep an eye on that. But anyway, so yeah, 30 to 70% is what I like to trim at around 15 to 25 points. Second trim is usually at about 40 to 50 points. And again, that just depends on the same 4 things that I'm talking about right here. These are really, really important. Where are my swing highs? Where are my fair value gaps? Where's my liquidity? So usually TP2, usually 40 to 50 points. And then pretty much I usually just have like 1 more TP, and that would just be my last 1 or 2 micros at that point. You know, maybe it's 100 points. Maybe there's a high time frame draw on liquidity, like, you know, even on this example right here, you know, you have my indicator marking out, we have an hourly swing high and a 4-hour swing high. So like if I was in this trade and I had 1 micro left, I would just hold it for these highs, right? So that's kind of what I do in terms of trimming. And again, the beauty about trading is we can both be profitable trading the same exact strategy, but with different ways. I can't stress this enough. What works for me may not work for you. The way my brain's wired and my risk tolerance and psychology and personality, like that may not work for you. So it's all about trial and error. And that's where journaling comes in. You know, try taking partials, see how you feel about it. Try 1-to-1s, try 1-to-2s, and figure out the way you can extract the most profits with this system. So the last thing I want to talk about is you guys need to be trimming. Let me see if I can find examples here. December 31st. All right, so I'm gonna go back. Damn, I don't even know what time frame this is on though. Hold on. I'm gonna go back here and just show you guys something. December 31st. All right. All right, so the problem is I don't know what time frame. I have this marked. Hold on. Ugh. I wrote 10:10 and 10:25. See 10:10. Damn, can I just like go back to December 31st and look? Hold on. And 10. Oh, okay, so here we go. So this is really, really important. This is really, really important. I have 2 examples here. This is example number 1. This is 10:10, and then it even happened again. Okay, so this is really, really important. Like when you're trimming, guys, do not set limit orders, especially for your first trim. Okay, my first trim, I always use market orders to get in positions. I always use market orders. There's been so many examples, and this is just one of the examples here. Price will edge. It's not every time, but it happens. Price will edge and miss liquidity points or levels by 1 or 2 ticks and reverse all the way back. So if you get in a trade and you set a limit order, for an example, at these lows, this low would have never hit and you would have missed out on all this profit and it would have turned all the way against you, right? So for me, if it's within a 1 or 2 points, you know, if it's within a couple ticks, just take the money. Once you see price in that area, and especially if it starts to stall, just take the money. For me, what I like to do is, again, I'll hit limit sell, right? Once it comes down to my area and I know it's my trimming area, I have my cursor hovered over the market buy or the market sell button, whatever trim I'm trying to do. And then as soon as it happens, I just click it instantly with no hesitation, just straight conviction. And that's what you have to do, because like there's been so many examples like this. And again, this stuff like this can actually lead into tilt. You know, like if you sit there, you take a play, you miss your TP by 1 point, it comes back to break even. Now you're fuming because you should have made hundreds of dollars. Then if your next trade's a loss, now you're like, holy shit, what just happened? I went from I should have been green today to now I'm actually red, and that is going to cause you to spiral and tilt. So very, very important. The only time I really set limit orders is maybe like my 3rd or 4th TP. Once I'm down to runners, if I'm not like actively looking at the charts, maybe I'm going to the bathroom or I'm looking at chat, you could set your last limit order, but do not do it for the first trim, trust me. Okay, so that is the updated 2025 trimming guide. If you have any questions, please let me know. What is going on, guys? And welcome to another course video. In today's video, I'm going to be showing you the best way to pass evals, guys. All right, I'm going to be showing you how I pass evals, and I'm also going to be showing you the NFP CPI eval method. If that sounded like a different language to you, don't worry. It's just a way people trade and pass evals quickly, okay? So let's break this down really quickly. We'll bring in a trading window in here. All right, so if you're a beginner trader, treat it like a funded, okay? If you're a beginner, right? And a lot of you might be beginners watching this. So if you're a beginner, first 1 to 3 months, treat your eval like a funded, okay? This is very, very important because you want to build the conviction and confidence to pass an eval legitimately one time, just so you have that satisfaction and validation in the back of your mind, okay? This is what I always recommend to new students. Again, you may be bored and you don't want to sit there on an eval. You want to get straight to the funded and make real money. But as a beginner, it's more about building those steps and building that foundation. And this is a necessity, okay? Because if you can never pass an eval legit and you're just full porting and trying to get lucky, what makes you think that you are ready to actually get a payout? You don't. So I would do this first. You know, this might take a couple weeks. This might take a couple months, but that's fine, okay? Like I said in my other videos, high-paying jobs, high-paying skills, being a doctor, a lawyer, whatever, these take years. So you can actually afford to spend a couple weeks or a couple months trading eval and not making any money. You are building your skills as a trader, okay? So that is number one. If you're a beginner in your first 1 to 3 months, treat your eval like a funded. Honestly, I would just say to any person watching this video at least one time, whether you're 1 month in or whether you're 8 months in, try to pass an eval the right way first. Okay, now, once you're past your first 3 months, and let's just say you've passed an eval already, you're above 3 months in trading, and you have passed at least one eval legit, you can go aggressive, okay? Now, why do I like going aggressive? Guys, if you are a proven trader or a consistent trader with an edge, and maybe you've even gotten a payout before, there is no reason to spend a lot of time on an eval, okay? Because time is money, and you need to be as efficient as possible. In my other video with the evals and talking about prop firms, I said this is all a risk to reward game, ROI, okay? How much money you're putting in versus how much money you're putting out. I've known a trader, I remember a year ago, I'm not going to say any names, but I remember a trader, and he had an account he had an Apex funded account for around 6 months, and he never took a payout on that account, and he actually ended up blowing that account. There is no merit, there is no golden medal that anyone's going to give you for keeping an account alive for 6 months if you're not going to take a payout. I would rather somebody take a payout 2 weeks on a funded account, blow that account, than waste 6 months on a funded and not get a payout, okay? It's all about the ROI game. How much money you're putting in, how much money you're getting out, and you need to be time efficient because there's only, I don't know, there's only 18, 20 trading days in every month, okay? So if I'm above my first 3 months and I've passed an eval already, I'm going aggressive on every single eval. That's just me personally. I'd rather, especially the cheap evals, we're talking about Apex, Bullnox, the cheap evals that are only 20, 30 bucks, I'm going aggressive. I'd rather pass an eval in 1 day and I have to buy 3 of them than pass an eval in 3 weeks and I only buy 1 of them. Because that extra 40, 50 bucks I'm saving, I'm actually just saving in time, in weeks. So for me, that is worth it, okay? Because I feel like I have an edge. I've gotten a payout before. If I get to a funded phase, I like my chances in actually getting a payout. Those same exact trades I would take trying to pass the eval, I would be taking on my funded getting to a payout. Does that make sense? So that is just how I do it. That's how all the profitable prop firm traders do it. They all go aggressive. Pretty much all of them. Now, you don't have, I'm not saying that, oh, copy trade 20 evals at once and go aggressive and full port them. I'm not saying that. What I like to do is I have my funded accounts and I have my eval accounts. I like to copy trade anywhere from 2 to 5 evals at once, and I'm just full porting them, trying to pass them in one trade. And I just do that little by little, you know, every couple days, whatever. That's how I approach it. All right. So let's take a look how this method is going to look. So again, you're not just full porting a random setup. You're still waiting for a valid trade. Now for me, I have A setups and I have B setups. I like to rate them based on the confluences, the context, and everything like that. And all of the A setups I will take on the funded account. The B setups, those are going to have a little less win rate. I would say the A setups are going to have a 70 to 75% win rate. The B setups are going to be in the mid 60s. So the B setups, some of them I'll take on funded, but some of them, they're just not at that threshold. And I'll be like, you know what? I kind of still like this. I don't want to take it on my funded. Let me full port some evals and see what happens. And that's kind of my approach to where I can make progress on the fundeds and the evals naturally. Okay. So for Apex, right? For 1 day pass evals, which is going to be Bullnox and Apex, I like to pass them in 1 day because you can pass them in 1 day. So what happens is Bullnox allows, I believe, I believe Bullnox allows 7 minis, and then Apex allows 6 minis. So pretty much all I do is I buy a 50K account, I wait for a good trade, A setup or B setup, and I am literally just full porting. 7 minis is, I believe, 25 points. I think it's 23 points, actually. It's 23 points. And then 6 minis is around 30 points. So that's all we need. That's literally all we need. You go in with 6 minis. You set your TP to 3,000. So you pass it in 1 trade. And that's it. You either pass or fail. And I actually have a video. Here showing where I do that. So let me show this really quickly. You actually can see me doing this in real time. So here is an example. For this trade, I'm using micros, but you could see 70 micros. I enter. This is on an Apex account. I'm just full porting it, and then I drag my TP to where this would be pass in 1 trade. And again, you are not going to have a super high win rate doing this because, again, this is a super high risk, high reward type of style, but I don't mind blowing a couple extra evals if it means I'm going to save a ton of time. Okay, so in the next example, I take this trade with an eval and I actually pass. You can see right here, I pass this trade in 1 trade. It hits this TP. And yeah, so, and then there's one more example, I think. This trade here, I passed the eval. So, and then I even did this method yesterday. If I go to the profits channel in my Discord, I did this method yesterday and I passed 3 evals. Let me see. Where is it? Yeah, here we go. Passed 3 evals yesterday. So this is 3,200, 3,100, 3,100. This is just me copy trading evals, full porting, and saving a ton of time. I promise, guys, it may seem like gambling, it may seem high aggressive, but this is just the game you need to play when it comes to evals. On fundeds, it's a completely different story. I'm never full porting fundeds. I'm treating them very, very carefully, but you need to just get around these evals. Like, trust me, I know what I'm talking about. I've gone 6 figures in payouts. Just trust me. All right, so going in at number 2, the number 2 point for 2-day pass evals. This is going to be your top steps. This is going to be your lucids. This is going to be your my funded futures. Most of the firms are 2-day pass. There's not that many anymore that are 1 day. But for your 2-day pass evals, what I like to do is, again, you have a $3,000 profit goal on a 50K account, okay? What I like to do is 1,500 day 1, 1,500 day 2, and then you're sizing for 3 to 4 minis depending on stop loss size. If we're below a 20-point stop loss, I like to go 4. If we're above a 20-point stop loss, I like to go 3. Okay? And that is how I do it. So if we get our calculator here, 3 minis is $60 a point on NQ, and you need $1,500. That is 25 points exactly with 3 minis. With 4 minis, it's a little under 20 points. I think it's like 19 points or something. Yeah. So with 3 minis, you're going to need 25 points. With 4 minis, you're going to need 19 points. So you're just going to go for 1,500 day 1, 1,500 day 2, and then day 3, you can activate the funded. I'm telling you guys, this is the best way to do it. This is the best way to do it. you know, if it's a money situation, if you can't really afford to buy a ton of evals, I guess you can take it slow, I guess. And then again, once you get a payout and you actually have some breathing room, then you want to buy some more and then go fast. But yeah, going slow is just not efficient. It's really, really, really not efficient. So this is how I pass evals. This is how a ton of people in the industry pass evals. And I'm just trying to help you guys out, be as efficient and make the most money possible with these firms. So now let's go into the CPI eval method. So the number one, hold on, water break. Refreshing. All right. The number one way to pass evals in the most common method is what I showed you here. You just wait for a typical good setup, A setup, B setup, whatever, and then you full port. Here, what I'm about to show you is the second way you could pass evals. This is called the CPI eval method. So what's going to happen is if you go on the website Forex Factory, every single month we will have CPI and NFP. Okay, here is NFP right here, Friday, April 3rd, 8:30 a.m. Non-farm employment change. And then if I just go a little forward, here is CPI, core CPI. Okay, it's once a month, every single month. Now, what happens is these news events. Oh, my mom was calling. Now, what happens is these candles create a very, very erratic and volatile candle, usually 80 to 100 points. I actually have the data right here that I can show you, and I will show you right here. Give me one moment. All right, so if I go on my Discord, here's all the data. So this is the last here is the last 6 NFP candles, and here is the last 6 CPI candles. So you could see on average 128 points, 100 points, 175 points, 137 points. So what I'm trying to show you is that these two news events are going to create a gigantic spike candle right at that time, okay? Now, what you can do, I'm just going through the thread because I made a thread on Twitter. What you can do is you can set a bracket order just like this right before the candle drops. So the candle is going to drop at 8:30. Again, you can check this website. So April 10th, Friday at 8:30. So right at 8:28, 8:29, what you're going to do is you're going to take 6 minis and you are going to set a sell limit 30 points below the candle and then a buy limit, or I don't know the technical terms. I don't really care. I think it's stop buy and stop sell. You know what I mean. You're going to sell it. You're going to put an order 30 points above the candle right here. You're going to put an order 30 points below the candle right here. And then obviously you're going to set your TPs. And what's going to happen is we're going to hopefully get a spike with the volatility in one direction, and your eval will get passed immediately, just like this. Okay. You see my executions. I actually did this in real time on my stream, and that's what we are hoping for. We are hoping that this news event is going to spike the market one way and you will pass all your evals immediately. So this is not like, I'm not telling you as 100% win rate, but again, when we talk about efficiency, this is a really efficient way to do it because this requires no brain power. This requires no thinking. You just buy the accounts, set the orders, and this is going to win a lot more than it's going to lose. So this is the NFP eval method. Now for this method specifically, I will say this method specifically works a lot better with the one-day pass accounts. So obviously, you know, if you need to pass in 2 days, this doesn't really help you, because if it works and you make 1500 on day 1, you still have to take a normal trade day 2. So I don't really like this on the 2-day pass accounts. Maybe, I guess, if you already accomplished your day 1 and now you need a day 2 and that's going to be CPI, you can do it for your day 2. But I typically just do this on Apex and Bullnox accounts, anything that has 1-day pass, and just try to get those bad boys passed really quickly. So that is pretty much it. That is how to pass evals the right way, the efficient way. That's how I pass evals. And that's also some bonus sauce for you guys on how to do the NFP CPI method. So, you know, hopefully the next time we have these news events, you take action. We actually have NFP next Friday. So hopefully this course is out by then. If not, we'll have CPI April 10th. So hopefully you try it then. Have a good one, guys. All right, guys, welcome to another video. We are going to be talking about sizing and risk management. All right, sizing and risk management is one of the most important things in trading, and this is where a lot of people go wrong. You know, if your system cannot survive multiple losses and your account won't be blown, then you're doing something wrong. This happens a lot where I will be on a win streak with my community and everybody's super happy. And then when those eventual losses do happen, you know, I'll look over to my chat and people are saying, you know, I'm blowing my account. And it's like, dude, how are you blowing your account? We just won 10 days in a row. So your system needs to allow you to have losses because let's face it, guys, you're going to lose. You know, we talked about this before in the data video. Every single system is going to have wins and every single system is going to have losses. So this is the sheet that I have created. And this is based on a 50K funded account. Okay. I either risk $200, $300 or $400. And this is based on the fact that you are going to have $2,000 of drawdown. Most of these funded accounts are going to give you $2,000 of drawdown. So what I like to do personally on the funded account, 50K funded accounts, what I like to do on B setups, 200-ish, A setups, 300-ish. Okay, so we're going to talk about a few things. So number one, this is going to be, if you're not using a hard stop loss, which we talked about in the previous video, this is going to be an estimation, okay? As long as it's within the ballpark of 300, right? And then if it's a B setup, as long as it's in the ballpark of 200. Because unless you use a hard stop, you're never going to know the exact amount you risk. So now, how do I calculate what size I want to go, okay? Let's go to the current chart, for example. Let's just say, I want to try to find an easy example I can just show you really quickly. But okay, let's just say this short right here. Okay, if price comes down here, I draw this gap out, I want to take this short. So this is how I do it. So I am just estimating where my perfect entry would be and then my perfect stop loss would be. And if that is the case, I'm going to be risking about 21 points here, right? If I enter here and I exit here, I am going to be risking about 21 points. So then I go to my sizing chart and I'm going to say, okay, what grade is this setup? If it's a B setup, I'm going to use this column. If it's an A setup, I'm going to use one of these columns. Then let's just say for the sake of the argument, it's a B setup, okay? So now you go here, 21 point stop loss, 21. It is telling you to go 4 micros. If you wanted to risk 300, 7 micros. If you wanted to risk 400, 9 micros. And that's how you're going to determine how many contracts you're going to go. Because again, in trading, you're going to have to make a lot of split-second decisions, and you're not going to have a lot of time to sit there and calculate math in your head. So it's really important that if you just have this sheet and you're like, oh, boom, 21, let me go here, 21, boom, and you're done. And you're not sitting there, you know, doing calculations in your head, and that's going to mess your trade up. So that is what I do personally. Now, I will preface by saying, over time, I've been able to build a buffer on a lot of my funded accounts. And with these funded accounts, the trailing drawdown, or, you know, that trailing number is going to stop at a certain point. Meaning, on a fresh 50K funded account, you guys are only going to have about $2,000 of drawdown, and I'm going to have more. Okay, so just keep that in mind. Because of that, I'm able to, you know, trade a little bit more aggressively than on this sheet. And I'm not saying that you have to use this sheet like it's the gospel, but you should definitely use this like as a good foundation. You want to be in the right ballpark, because if this is telling you to go 9 micros, but you're actually risking 17 micros, then that's a problem. You know, you're over leveraging and you're going to blow your account. Because if you risk, you know, with 200, let's just say 250, let's get our calculator out. With about $250 per loss, what is that? That's going to be, that's about 7 to 8 losses. So assuming you risk about $250 per trade on average, that's going to be 7 to 8 losses depending on slippage. And guys, we've already went over the statistics. We've already went over the statistics in a previous video. Our model has a very, very, very consistent win rate. It is 77%. The chances you lose 7 or 8 trades in a row, as long as you're doing what you should be doing and following the checklist, is extremely low, guys. It is extremely, extremely, extremely low. So again, what can cause you to blow an account? It's going to be tilting, taking bad setups, over leveraging, spamming trades. But if you can just understand the math and the probabilities and just keep every single trade on its own, you know, just risk 2 to 300. Again, risk 2 to 300. Another trade, risk 2 to 300. If you could just keep doing that, the probability will play out in your favor, and it's going to be very, very hard to blow an account just trading it like this. So that's how I use the sizing. The only other thing I can think about is some people might say, like, when should I go more aggressive than normal? And the only time I really recommend doing that is some accounts have a buffer. Okay, for example, TPT, Take Profit Trader, the accounts have a buffer of 2,000, meaning you can't request any money until you're over the buffer. So I've talked to a couple of profitable traders. What they like to do is the first couple of days, they will go aggressive, more aggressive than normal. They'll go about double this risk. And that's because they're just trying to get above the buffer as fast as possible. And this is a very high leverage way of trading. But then if they're able to actually get over the buffer, any other profits on those other days is now right into their bank account as a payout. So what they like to do is, you know, days 1 through 3, they'll double their risk here. They'll try to get over this buffer. And then once they're over the buffer, they'll go back down to normal risk. And now they can, you know, be eligible for payout. So I have seen that. Just keep that in mind if you're trading an account with a buffer. And other than that, I mean, I don't have anything else. Sizing is very, very unique, and it's going to be unique to you, man. There's going to be certain setups where you absolutely love and you want to risk 300 on it, and there's going to be certain setups where you don't like and you've had bad experiences with and you want to risk less, and that's going to be a journey that you're going to have to go through. Sometimes another thing is, like, sometimes if I see a trade and I want to risk $300 on it, but then the trade starts getting worse and we might start chopping, we might start consolidating, I can always de-risk, you know, whenever I want, as long as I'm not in the trade, obviously. So it's not set in stone. But I would say in general, my sizing amount is directly correlated to the quality of the setup. It has nothing to do with how much money is in my account, you know, how far away I am at payout, nothing. It is always directly correlated to the type of setup that I'm taking, okay? And that's pretty much it. The only other thing the final thing I want to talk about, I think I talked about this in a previous video. Do not lower your risk just because your first trade loses, okay? I already mentioned this before, but if you lose $200 on trade number 1, you have to go $200 risk on trade number 2, or else you're going to ruin the math and the statistics, okay? A lot of people get scared. They half their risk after one loss, and then even if you win that next trade, you're not going to be green. You're either going to be small red or break even. So do not lower your risk, okay? Because even if I do this method right here, this is going to give me 2 to 3 losses a day. And that's going to be my max loss in a day. I never let it get above 800. So my max loss in a day is going to be, it's going to range anywhere from 600 to 800, just depending on how much I risked on each trade. And after that, like, I'm done for the day, you know? But, you know, a solid win, like a solid base hit, is going to make me $200 to $300. A really good trade, something like 100 points, you know, something like I caught today, this is going to net me anywhere from $500 to $800, just depending on how the runners go. So very, very important, guys. You don't need to risk a lot as well, because the risk reward on this model is really, really good. And yeah, so thank you so much for watching.
All right, what is going on, guys? It's Tempo Trades. Excuse the background, I am in Italy, but we're going to record this course video for you guys, and I'm pretty much just going to go over almost every single day of my 16-day win streak. In March and a little bit of February, we won 16 days in a row trading this exact strategy that we've been teaching you on this free course. So let's put it all together now. We've gone over basically every single confluence in the course on this list. We've talked about kill zones, liquidity sweeps, premium and discount, everything like that. So we are now going to just bring that all in together and go over it all. So let's start. I want to go find day one of the win streak. Okay, here is day one. So I'm going to use a combination. I'm going to use a combination of the chart as well as the trading live streams that I have. So just keep that in mind. So it looks like here's day one. I also have to, refresh my memory a little bit. Okay, so here was day one of the win streak. This was on NQ. And this is a pretty self-explanatory setup. This setup actually happened pre-market. And again, when I talk to you guys about the kill zones, you don't want a lot of your trades pre-market. I would say maybe 10 to 20% of my trades are actually pre-market, and an overwhelming majority of my trades are during that kill zone. So this is one of those 20% of the times where I just saw something pre-market that looked really, really good, and I wanted to risk it. So what did I see? It's pretty self-explanatory. We have a 4-hour sell-side liquidity level right here marked out by my indicator. So I knew that when price came down and swept that level, I would look for a reversal out of that level. And we also created a nice big 1-minute fair value gap. So I essentially just waited for price to get over that fair value gap. I entered long, and I trimmed at about 20 points. And I do remember this day specifically. The reason I trimmed early is because ES ended up sweeping that high to my right. And this ties into the trimming video. A large majority of the time, I do not trim with limit orders. I am just using the market button, market buy, market sell, all manually. Because if I would have had a limit order at this high right here, it would have actually missed and I would have not made any profits on this trade. But because I was seeing that price on the right was sweeping that high and NQ was not sweeping this high, that was creating a bearish SMT, bearish divergence. And if price were to start stalling in this area, there's a good chance we actually reverse. So I use the SMT concept to tell me to trim early, and that's exactly what I did. Okay, so that is day one. That is day one of the win streak. Let's hop on to day two here. What did we take on day number two? Let's see. Again, this was over almost a month ago, so it's not super fresh in my head what we took, but this is, okay, looks like this is what we took right here. So again, very, very, very simple, guys. Very, very, very simple. We marked out, this was actually right at 11 a.m., so this was inside the kill zone, but right at the very end. We marked out our sell side liquidity level, which is previous day low. Again, if you want to know all the levels that I use for liquidity sweeps, it's in the liquidity video. 1 hour, 4 hour high lows, Asia, London high lows, previous day high lows. Previous day high lows are super powerful. Honestly, they're even more powerful than the hourly and 4 hour because, technically speaking, the higher the time frame, the more liquidity should be resting there. So very, very nice level right there. Marked it out, waited for price to sweep it, looking for a reversal out of it, and then I entered long on this 2-minute time frame right here, and I'm pretty much just targeting, 20 points, take a trim, 40 points, take a trim, etc., etc. Do I show my executions on this one? I don't think I do. Okay, I don't. But here is day two of the win streak. I don't know who is tagging me on Discord, but yeah. Okay, here is day number three. So as you can see on day number three, I actually took 2 wins and a loss, which probably means my first trade was a loss. And I ended up bouncing back and ending green. I would trying to see what my first trade even was. Okay. Okay, it looks like this was one of the trades. Looks like this was one of the trades that I took. I'm going to increase my face cam size a little bit. Looks like this was one of the trades I took right here, and just using context, ES on the right is sweeping London high, so I'm actually using the ES liquidity sweep to take the NQ trade, and this is completely viable, completely valid. Obviously, the NQ and ES are both indices. If NQ is supposed to go down, ES is supposed to go down, and vice versa. So if ES sweeps liquidity and you're looking for a reversal, you can also look for the same exact trade idea on NQ. So it's completely valid. Basically, just taking that sweep 1 minute time frame short. I'm trying to find the loss here. This might be the loss right there. Kind of a confusing day because there's just so many trades. So I'm going to move on to the next day right here. Then the next day, did not take a trade. And again, you don't have to take a trade every single day, guys, especially when you're on a win streak. If you ever are able to get on a win streak, there's going to be a lot of pressure on yourself, in your psychology. It's like, damn, I've won 10 days in a row. I really want to take a trade today and make it 11. But you just got to realize, especially on these win streaks, that you just got to take it one day at a time. You can't force things. And there are going to be days where you just have to sit back, wait for the next day, and that's it, okay? Let's look at this day, February 26th. Let's see what I took here. Looks like it was this, boom, yeah. It's just, damn, my face cam was so big that day. It's just rinse and repeat, man. It's literally just rinse and repeat. And what you're noticing with a lot of these trades is I'm just simply taking reversals off of key levels, and that's it, man. That has simply made me so profitable, so consistent, and so good at trading. Another day, I'm marking out a key level, right? You're marking out Asia low on the left. Once it sweeps, I'm looking for longs. I find a 30-second IFVG that is 18 points. It's a good size. I'm waiting for that thing to inverse, and I'm entering long and targeting the top side. There is a pretty good teaching moment here on the right. You can see ES missed the 1 hour swing low, that red line. It actually missed that 1 hour swing low barely. And some people might ask, like, hey, in this case, don't you want to wait for ES to sweep all its levels too? And the answer is it depends. It depends. I would say in an ideal world, NQ and ES sweep all the levels and the reversal happens. Because that way, you don't have any questions of like, okay, is this going to be a fake out? Is ES actually going to fake us out, reverse, go for this level, and then make the move? You never know if there's levels down there. But what I always say is it all depends on the reactions and it all depends on the momentum. If NQ sweeps the level and it's showing me with its movement that it's ready to reverse, I will take it. Full knowing that, man, it could end up coming back down one more time to take out these levels. And that's just the risk I'm willing to take. But there's going to be a lot of times where you'll have two levels, NQ will only sweep one of them, and then leave that other level lower and then make the reversal. And if you're sitting there scared and hesitating, you're just going to miss the move. So in those situations, you have to judge it. You have to give your objective opinion on it. How do you like it based on all the other confluences and decide whether or not you want to risk it or not. And you can even go lowered risk. You can even be like, okay, I was going to go 10 micros, but now that there's this level here that might mess this trade up, I'll only go 8 micros or 7 micros or something like that. So yeah, that's the trade I took. Let's go on to the next day. Here is the next day. Which looks like a data setup here. Got a data candle and didn't get that trade. Oh, okay. Here's the trade. So here's the trade I took on this day. Very, very simple. We created a data candle. I don't know what news event this was. I'm trying to see. Looks like PPI. Okay, so on this day, on February 27th, we had PPI. That means at 8:30, there's going to be a data candle, and all we're going to do is we're going to wait for one side to sweep, and then we're going to target the other side with an IFVG entry. You could see we sweep the bottom right there. So now what are we looking for? We're looking for longs to the top, okay? And that's exactly what I take, because as you can see right here with my fill and executions, I enter long on an IFVG and I ride that thing up. Funny part is I don't think this hit all the way to the high, but it still went up 50 points. So yeah, it didn't even hit the full high, but we're still making money because it went up 50 points and we're trimming before that high gets hit. So very, very nice move right there. You know, these data setups, they don't appear every single day or sometimes not even every single week, but when they do appear, it's very important that you take them because these data setups have a super high win rate. So make sure you have Forex Factory on your computer, Financial Juice. These are two good news websites to check when you're going to get economic news. And yeah, very, very, very nice win right there. Here is day number 6. What do we take on day number 6 of the win streak? What was this? This was 1 win and 0 loss. Okay. I don't even know. Oh, I think this might be a draw and liquidity play. Yeah. Okay. Okay. Looking back at it, this is an extremely risky play. So looking back at it, this is very, very risky. Now, up until this day, you have seen that I've only pretty much taken trades off of key levels. Those kinds of setups are considered my A setups. Those are going to win, 75% of the time with my data. But the draw and liquidity plays are my B setups. Those are going to be in the 60% win rate, somewhere in there. And I try to take more A setups than B setups, but sometimes I will take B setups. So this is a B setup. What is a draw and liquidity play? A draw and liquidity play means you're not taking the trade off of a key level. You're pretty much taking an inverted fair value gap in the direction of a key level because you're anticipating that price wants to go sweep that key level. So in this example, you can see we have Asia high up there at 24,900, and I'm expecting price to go take that level out, and I basically want to take this move in assuming that it will. This is a very risky setup looking back at it because, number one, we talked about momentum. The momentum on this trade is really, really bad. We chopped inside of this fair value gap for like 5+ minutes, and there's no liquidity sweep. So I'm kind of surprised I took this one, to be honest, but this is probably the worst trade I've seen, looking at it. And then you can even see we did end up getting the short move once we swept that Asia high. I just ended up taking that long first. So you can take draw and liquidity plays. They are valid. They do have an edge, but majority of your trades should be those liquidity sweep trades, okay? All right, moving right along. Here is day number 7. Here is day number 7 on the win streak. Is that it? Oh, I guess that's it. Okay. All right. So again, going back to, let me see. Yeah, going back to taking trades off key levels. I had a 1 hour swing high marked out. It was also the start of a 1 hour fair value gap. So this is kind of a bonus tip for you guys. If you can get a if you can get a liquidity sweep inside of a high time frame fair value gap, meaning the hourly, 4-hour, or daily, that is even better because now you have two confluences stacked on top of each other telling you that price could reverse in this area. So look out for those. I don't know if so I go on the 1 hour time frame right here. So you can see I go on the hourly. We have a swing high. We have a swing high right here inside of this fair value gap. So that is even better of a confluence telling us that we should look for a reversal. It looks like I looked for a 1 minute short, entered short, and then I trimmed down here. Now, some people might ask, oh, why did I trim here and not down here at this wick? And that's very simple because this is a fair value gap, okay? At this point, I was up 40 points in profit, and we're touching a fair value gap. So the main two areas where I will look to take profits is when we're hitting a swing high or swing low, or when we're hitting another fair value gap, okay? So that is why I didn't wait, and I ended up taking profits there. Even though, I have my TP there, I did take profits there. So, okay. All right, now goes on to day number 8 of the win streak. Looks like this is a continuation setup. Interesting. Looks like I took a continuation setup here. Huh. Oh, because there's an SMT. Okay, because there's an SMT. All right, so this is a continuation trade. This is going to be a B setup again. This is going to be a B setup, but you can see just in these examples how much more often I'm taking A setups over B setups. So in the end, it will be fine. So you can see on the bottom of the screen we have bullish divergence, meaning it looks like this was like the 958 candle. You can see that NQ swept this 958 candle right here, but if we go on the same exact candle on ES, or this might even be the 10 a.m. candle, but you could see the same exact candle on ES. ES did not sweep that low, creating bullish divergence. And then I guess this was in an uptrend, and I wanted to take a continuation trade long off that SMT, and I pretty much just targeted the high of the day, and it worked. So yeah, it looks like we were just trending this day, and I was looking to get in on the action. So that is pretty much it. There's also another short here. This one's a nice one as well. We have a weekly high, liquidity sweep. Get that sweep, wait for that reversal, boom. Nice, very nice. Very nice, okay. Let's move on to the 9-day win streak. Looks like my first trade of this day was a loss. Here was the win. Or wait, no, that was a break-even trade. This is what happens sometimes. So this is what happens sometimes. I was looking at this trade. I was looking to take this reversal off of this London level, and market open happened right there. So I had to get out of the trade, and then price instantly flushed exactly where I wanted it to flush. This happens a lot. I've made it a rule that I really don't like to trade 5 minutes before open, 5 minutes after open. It's a crazy, chaotic time with price action. Like it feels like a casino, honestly. So I've just made it a rule, or try to be very, very aware of that. In this instance, it would have helped me because I wanted to go long and it would have shot up, but very easily it could have just spiked for no reason at open. So I don't suggest you guys take open trades. It looks like this setup right here, I took a loss. I was looking to take a short off of 50% tap of the daily range. As you can see up here where my cursor is, we wicked that level, and then I just didn't go break even for some reason. Maybe I did go break even. I can't remember, like I said. If I did go break even, this would have been a break even trade. If I didn't not, this would have been a loss. And then let's look at this next trade. This is textbook. This is absolutely textbook. Yeah, this is absolutely textbook. So again, this kind of goes into our previous point, is like, should you wait for every single high to get tapped or liquidity level to get tapped? And the answer is no. You see right here, we have London high, Asia high, and a 4-hour high. And if I would have waited and been like, damn, I don't want to short yet because we missed Asia high, I would have missed this move right here. This is a 45-point move. So, and you can see here I took the trade. So as long as we get one sweep and we get the correct and appropriate momentum and pattern, I will take the trade and just risk it most of the time. Look at that trade. Wow. Look at that. Look how it moved all the way down. And again, if I would have been scared and waited for that Asia high to get tapped as well, I would have missed that whole trade. So here is the 10-day win streak. Again, pretty simple, pretty textbook, man. We're doing this. This is what I love about this model, bro. I traded so many different models, VWAP, EMAs, all that bullshit, and it was just so confusing and objective, and this is just black and white. Like, this is just literally just black and white. You mark your levels, you wait for the levels to hit, you take the reversal. Very, very clean. Very, very clean. Okay. Like clockwork, man. Like clockwork. We have the London high. This is the 11-day win streak. We have the London high. London high sweeps. I take the 1 minute short. Boom. You get the reversal. And again, some days you're only going to get 20, 30 points on the reversal, and some days, like I showed you, you're going to get 100. It's like I'm just going to react to what the market gives me. I don't need 100 points every day to be profitable. I'm not going to try to predict what the market's going to do. I'm going to lay out my TP areas, take profits along the way, and just react. That's the main advice I can give you. So here is day number 12. Again, it looks like the first trade was a loss, so I don't lose my composure. I don't completely freak out just because the first trade was a loss. Yeah, so here's the loss right here. It looks like we got a data candle at 8:30. I don't know what news this was from, but it looks like we got a data candle at 8:30. We swept the low right here, so now I'm looking for a reversal up to this high. I ended up taking a 15-second long, which is risky. I typically stay away from the 15-second time frame unless it's a data candle. That's the only time I make an exception. And in this instance, it failed me. But instead of losing my composure and freaking out, I simply just waited for another opportunity. I ended up taking this 2-minute long right here. And I believe this worked all the way to the high. Yeah, worked all the way to the high, as you can see. So, just because you take one loss, guys, don't just completely lose your emotions and your composure. You need to analyze the situation, see what you can do to get another opportunity, and execute your edge. And here's a clear example. There's probably a lot of stress. I was on a 12-day win streak, a lot of stress, a lot of pressure, and I ended up getting out of this day green to continue the win streak. So you're going to take losses. You're going to take losses no matter what. It's all about how you react and manage those losses. Here's day number 13. Here is day number 13. Very, very, very simple. It's what I've been teaching you guys this whole time. London sweep, wait for the reversal, enter on the IFVG, target the other side of the range. And again, you see the yellow line is here. So we're at the bottom of the range. So you should want to be longing back to the yellow line. Very, very, very clean. We only have a couple more days to show you. Here's the 14-day win streak. 1 second. By the way, at any point in this video, I should have said this a lot earlier, but at any point in this video, if you had any doubts that I took these trades and I'm just cherry picking, if you're in the premium Discord, every single live stream I ever do is posted, so you can go back and watch me call these setups out in live time, where I'm clearly saying that I'm taking the trade. So none of this is cherry picked, I can assure you. This is all done in live time. So I think this day was a really, really small win. Yeah, I think I took this short on ES here. It looks like I took this short on ES here on the right. Just for a very, very small profit amount. Here is day number 15. Last 2 days of the win streak, and then we take the loss. Okay, so what the heck happened here? Okay, so it looks like here is the win I took. Again, this is a data play. We create the data high at 8:30. We sweep the low. So now I'm looking for longs back to the high. I ended up taking this long, and I did trim some at 20 or 30 points because, again, we're hitting a higher fair value gap. You could see it only looks like it was 20 points. You could see this higher fair value gap right here. So I'm going to trim some profits and then hold runners in case we actually go up to this data high right here, which we did not end up doing, but I'm still small green on this trade. So on this day, I didn't make that much money, but you got to cover your bases. You can't be stupid and greedy and hold your entire position for this high, because you never know what price is going to do. You never know what price is going to do. You got to react, not predict in these markets, okay? And here's day number 16. Here is the last day of the win streak. Someone is calling me, but I'm recording. So here is the last day of the win streak. Looks like I took that. Looks like these are just little scalps. Yeah, so there's another little short. I want to go over the last day of the win streak while we finish up, wrap up here. So this day was tough, man. This day was tough. This was OPEX, which is the third Friday of every month. This is when a bunch of option contracts expire at the same time, and you usually see a lot of manipulation, poor trading conditions, and all of that stuff. And honestly, like I knew that going into it, but based on the last couple of OPEXs in the previous months, I think we've managed them pretty well. So I was just like, you know what? I'm okay giving this a shot. And I fully knew going into this that it was OPEX, and I got cooked. I got absolutely cooked for the first time in over a month at this point. I had a red day, and, you know, the same exact trades. I did nothing differently. The same exact trades that I was taking on all of these other days, the same key level reversals, they just didn't work for whatever reason on this day. And you know what? That's fine. Here's the first trade I ended up taking. Lost almost immediately. It looks like this was probably like an hourly low or something. Lost almost immediately. Then we got so much chop here. I mean, look how much consolidation. Again, there's no business in me trading this. I shouldn't have traded it. And it is what it is. You know, it is what it is. I think this was the second. I think this was the second trade, maybe, if I remember correctly. I tried to take a draw on liquidity play down to this daily low, and I got in a little bit early before the candle closed, and it faked me out. And then where was the last trade? And then I think this was the last trade of the day. So here was the last trade of the day. We put in a bullish SMT Divergence. I also recall this. We were sweeping something, and we were delivering off a high time frame fair value gap. So yeah, really, honestly, just looking back on this day, I could have stopped after the first loss. I could have understood that, hey, today's OPEX, I took this level reversal. This is the same trades. These are the same trades I've been taking the whole month, and I've been winning so much. I just shouldn't be trading on this day. And, you know, for my stubbornness and for probably the reason that I wanted to extend my win streak, I decided to take a couple more attempts that probably weren't super high quality, and I and I paid the price. I paid the price. So I ended up losing. I think I lost $20,000 on this day, March 20th. So we know that going into the next OPEX. But guys, hopefully you enjoyed. This is a full breakdown of my 16-day win streak, kind of going through every single trade, why I took it, and the confluences. So hopefully you enjoyed, and I'll see you on the next video.
What's going on, guys? It's your boy Tempo Trades. In today's video, we have a bonus video for the course, and that's going to be talking about how to trade the model during London session. A lot of people, they're in different time zones, they're in all different parts of the world, you know, whether it's Asia, Europe, America, and, you know, because of their job or because of outside circumstances, they're not able to trade in the New York window. So if I couldn't trade in the New York window, and, you know, for whatever reason, my job, I would do two things. I would either trade New York PM or I would trade London. I think London is a little bit better than New York PM in terms of consistency. Now keep in mind, this sun is like super bright, so excuse me, but keep in mind I don't have the same amount of forward testing and experience I do on you know, London compared to AM. I've only traded London a handful of times, whereas I've traded AM consistently every day for the past 4 years. So I do know just from talking to other people and from messing around with it myself that it is viable. So this is what I would do. Okay, so we talked about liquidity and we talked about kill zones. First of all, let's just talk about the London kill zone right here. My London kill zone is 2 to 5 a.m. EST, so that's where I would trade if I had to trade London in between 2 to 5 a.m. Now, the main area that I would look for London is simply the Asia session, okay? Right? The Asia session ends at midnight. So then there's a little bit of a lag time between midnight and 2 a.m. New York time, okay? And that's when London session finally starts. Now, what I would do is as soon as the Asia session ends at midnight, I would set the high and I would set the low. If the high sweeps earlier than 2 a.m., as it does in this scenario, you can look to trade a little bit earlier. If not, just if it doesn't sweep, basically just wait for that to sweep during the London session. So it's not always going, but basically, long story short, you are going to look for a reversal from the Asia high back down to the Asia low. It does not happen in this example, but if I just go back and I look at this example, look at this. Look at this. It does exactly what we want it to do. So right here, boom, you have the Asia low. It's all the way back here. You wait for this Asia low to sweep, and what happens? Price reverses all the way off the Asia low, all the way up to the Asia high. This is pretty much what I would look for every single day. And that would be my main, strategy if I had to trade London. I'm just marking out the Asia high, marking out the Asia low, looking for a reversal. Now, you can mark out some other areas, like you can still mark out, so I'll write it down here. Let me put this in white. Okay, boom. So Asia, high, low. You could do the 1 hour, high, low, 4 hour, high, low, and then previous day, high, low. These are the four main areas of liquidity that I would look for during London session, and you're just waiting for these sweeps, okay? But this right here is the main one, that Asia high low, okay? I'm very, very curious because I don't have the raw numbers to tell me how consistent the Asia session or the London session is compared to the I don't have the numbers to show me how consistent the London session is compared to the AM session. I just pulled up the wrong thing. That's funny. But here are the numbers for the AM session. Okay. So boom. All right. So here are the numbers for the New York AM session. This is a back-tested, verified, data collection with 177 trades. The model's got about a 77% win rate, 80% if you just take a 1-to-1 RR. So I would imagine in terms of London session, this is going to go down probably to the mid. It's probably going to go down to the low 70s, maybe even the high 60s. It's still going to have an edge, but London session and the New York PM session are not going to be as consistent as the New York AM. So that's why I always say, if you can wait, just wait for New York AM. Like for all my people out there in Europe, you obviously have the option to trade London in the morning, but why would you trade London in the morning if you can just wait 6 more hours or whatever it is, and you're going to have a much higher win rate or chance to be successful, So that's just something to keep in mind. But it obviously, if you can't, and life is life, and you have to trade London, this is what I would do. And I still think you can be successful. I still think you can make payouts and all that good stuff because I have seen people do it. The last thing I want to pull up is I made a tweet not too long ago about the kill zones. Yeah, here it is. So I made a tweet right here, the best times to trade. New York AM, 9:30 to 11 a.m. EST is number 1. London session, it squeaks out New York PM by a hair, literally by a hair, but I would say it's a little bit better at 2 to 5 a.m. New York PM, 2 to 4 p.m. And then everything else isn't worth trading, in my opinion. Literally everything else is not worth trading. Do not trade Asia session. Long term, the edge is much, much less consistent than the other kill zones. So yeah. And my alarm's going off, so that's cue for me to head out of here. So hopefully you guys enjoyed, and we'll see you on the next one. What is going on, guys? Tempo Trades. In today's video, we're going to be talking about chasing. Guys, this is probably the most requested and most talked about aspect of the model by far. This is the hardest part of the strategy. This is the most talked about part, and we're going to be talking about it today with maybe more than four examples. So let's break it down, okay? What is chasing? Now, in a normal IFVG setup, you guys have learned that if you want to take a long, you wait until the candle closes and you enter long. And if you want to take a short, you enter when the candle closes below the gap, right? So a long, candle closes above the gap, you enter. If it's a short, candle closes below the gap, you enter. That is the normal IFVG way to trade. But there are going to be very specific times where, there's all the confluences look good, the trade's great, but because volatility and momentum are so high, you're not going to have the luxury to wait for that close. Because let's just say it was a short, by the time price closes, it might be all the way down here where it's already hitting its first TP, and if you would have waited for the close, you would have not even been able to get into the play, okay? So that's where chasing comes in. Chasing is a calculated, risky, but effective strategy where you are basically getting in early under the assumption that the candle will close so you don't miss the trade, okay? Now, I do not chase on every single trade. I would say probably rough estimate 25% of the trades you actually have to chase on. It's going to be better and it's going to be worse in different moments. Like during times of super high volatility, you'll have to chase more because that's just what the market's doing. And during normal times, you'll have to trade less. So we're going to talk about chasing. And I'm going to break down some examples, and we're going to go frame by frame when I would chase and kind of my mindset in that. And yeah, so another thing I want to talk about really quickly, this is going to be a long video, so get comfortable. Probably it'll be a 20-30 minute video. So the first thing I want to talk about is something I like to call the ideal entry zone, okay? The ideal entry zone. What does that mean, okay? Now, let's just use a long as an example. If you are taking a IFVG setup long, you have two ideal zones, okay? Your first zone is going to be your entry, right? So the ideal zone for your entry is going to be a couple of points above the fair value gap. Obviously, you don't want to get in all the way up here because at that point, price is already reversed 30, 40 points. So you don't want to get in up here. The ideal entry zone for this fair value gap is a couple points above the fair value. A couple points above the fair value gap. That's your ideal entry zone. So once price starts getting above your ideal entry zone and the candle still hasn't closed yet, that is when you would look to chase, okay? So again, if there's like 30 seconds left in the candle and price is starting to push up here, it's now above your ideal entry zone. That's where I would be like, okay, now might be a good time to chase, or I might just miss the trade. And it's the same thing, getting out and using your stop loss. Your stop loss is especially if you're using a soft stop loss and not a hard stop loss, your stop loss is a couple points below your fair value gap. This is the ideal exit zone, okay? And now again, if I'm using a soft stop loss and price starts going below my ideal stop loss zone and there's like 30 seconds left, that's where I would be like, okay, I think it's time to get out. So again, there's no like hard science of points, and this is probably the most subjective part of the strategy. And again, you have to make a decision for yourself. Like some people, they sit there before I even get into chasing. Some people, they sit there and they're like, you know what? I'm not good at chasing. It hurts me more than it helps me. I'm just not going to do it. And when those trades come where they have to chase if they want to get in, they just sit there and they're like, you know what? I'm not going to take this. It's fine if it goes without me. And that's okay. You can do that and you'll be fine. But you have to understand there's going to be a handful of trades every single month where you're going to straight up miss and they're going to work. For me, I'm good at chasing. I think it helps me more than it hurts me. and that's why I do it. So you have to figure out for yourself that kind of dynamic. And yeah, so all right, next, another thing I want to talk about is sizing for the chase. Okay. Another thing I want to talk about is the sizing for the chase, okay? We will talk about this a little bit more when we look at these examples, but what I like to do is half size. So we want to limit our risk as much as possible with the chase. Obviously, it's risky when you don't get the candle close. There's no confirmation if the trade is even valid yet, so we're getting in early under the assumption that it will close. But to even lower our risk even more, what you can do is you can actually cut it down to half size, okay? So let's say right here, you wanted to enter 10 micros, okay, on your trade, all right? Let's say right here, you wanted to enter 10 micros, but there's 20 seconds left and price has shot up all the way up here and it's now in this area. I don't want to enter 10 micros right there because, again, my ideal entry zone is right there, right above the fair value gap. Do you understand? So what I would do is if I had to chase here with 20 seconds left, I would simply enter 5 micros here, which is going to be half size, and then I'm going to wait the next 20 seconds out, okay? Let's just say right here was our take profit area, okay? Take profit. So now I'm in with 5 micros. There's 20 seconds left on this candle. Here's what I would do, okay? In the next 20 seconds, if price continues to go up and it hits this take profit area, I'm just going to use this trade half size and I'll trim wherever I want to trim. I'm not going to add any more, okay? Because at that point, it's already hit the take profit area. It's probably hit a swing high, maybe even a fair value gap. You don't want to enter any more contracts because you're going to get a worse fill, and it just doesn't make sense. You're going to have to trust me on that, okay? But in the next 20 seconds, if the candle closes above the fair value gap and now we get confirmation that the IFVG is valid, you can look to re-enter your next 5 micros. And what I would do is, let's just say 20 seconds passes, right? The candle closes right there, and now price retraces back. Here is where you can look to enter your next 5, okay, on a retracement. Again, when we talk about the ideal entry zone, for every single setup, you want to get your entry, your fill, as close to that as possible. Right above the gap for longs, right below the gap for shorts. So I'm not going to, enter 5 and then enter another 5. So now my fill's up here because that's going to be 20 points above my ideal entry. That's not efficient, okay? So I'm going to wait for a retracement, and then you can either enter 5 here, or if you're not really feeling the play and you want to be even more safe, you can actually wait for price to dig into your fair value gap, and then you can enter there. And what's going to happen is your fill is going to be the average of this entry and then this entry. It's just going to place you in the middle of those two entries. That's how it works. So that's what I would do with chasing. Very rarely do I enter a chase with full size. I would say the only times, and maybe we'll go over that in the examples, I would say the only times I go to a chase full size, excuse me, the only time I chase with full size is if I have to chase and there's literally under 5 seconds left, and the chances that we actually close above or below that gap is, it's going to be 90+% when there's that much time left. So, but if there's 20, 30 plus seconds left and I have to chase, I'm pretty much going half size, a very, very large percentage of the time. Okay, so let's get out of there. Hopefully that helped you. And now let's go into some examples. So these are real examples on my live stream that I actually ended up taking. We're going to kind of go frame by frame here, and I will explain the point that I would get in the trade. So again, this doesn't look like that good of a setup. Here's another tip for you guys. The better the setup, the more aggressive you should want to chase. The worse the setup, the less you'd want to chase and the stricter you'd want to be. There's some setups that are, I classify as B setups or C setups. These setups are not going to have as many confluences. They might be outside of the kill zone. The momentum might be bad. And some setups, I might just be like, look, I'll take it, but I'm not chasing. This setup's not worth chasing on. If it goes without me, it is what it is. And then you're going to have setups where there's 6, 7, 8 confluences, and it's like, I have to chase. I have to get in this no matter what. This is a really, really good trade. And I might even get in on the candle when there's 60 seconds left because that's just how good the setup is and I want to risk it. So just keep that in mind. There's a positive correlation on how good the setup is and how aggressive I'm going to chase on said setup. Okay, so this does not look like that good of a setup, just eyeballing it right now. This, what's so funny? Oh, okay. This just looks like a B setup, and you can see right here, price has wicked above this gap multiple times, but it never closed. So you definitely want to be careful when you see a lot of wicking because you're going to be prone to fake outs. That's the worst. When you chase with 10 seconds left and then price wicks you and it ends up closing below the gap, now your chances of success are going to be much lower. So in this example right here, there is 10 seconds left. And honestly, right here is a good area where you could chase. It's about 1 point above the fair value gap. So you're pretty much in your ideal entry zone. And there's 6 seconds left on the timer. So the chances that price closes above this gap here is very, very high. If you wanted to wait, let me play the timer here. Okay. You know what's crazy? I said that and price didn't even close. Wow. I would have chased there, which is funny. So now let's just say I chase there. Let's just say I chase there for the sake of the argument. Now, I'm happy I said that because now we have a good example because this is going to happen to you. Sometimes you're going to chase and price is not going to close and you're going to be sitting there like, holy shit, what do I do? You have two options. Number one, you can continue, especially if you're only in with half size. That's why I like the half size idea because it allows you to be a little bit more flexible. Now you're in with half size, you chased, price did not close. You're sitting there. You got to ask yourself, how much do you like the trade? If you still like the trade, you can continue holding, especially with half size, and you're just going to hope that the next candle closes. Or if it doesn't close and you're in with half size, you have to say, okay, do I want to get out and maybe take a half loss or take a small loss? You have to kind of feel out the situation. In this example, the momentum looks pretty good here, so I would probably just hold it, especially if it's half size. We'll continue. Let me continue to play this candle here. And that's how crazy the chasing stuff can be. I mean, you could see here with 1 second left on the timer on the right, you could see that there's 1 second left. Price actually doesn't close, which is crazy. So sometimes it happens. It is what it is. But now, for me, I'm seeing how good the momentum of the last candle was. I'm probably looking to chase on this candle. And I will probably pause the moment where I would chase here. Very close. You could chase here, honestly. Let me show you. And boom, right here. So right there is where I would chase. Once you see that, little positive bullish candle movement right there, I would chase right here with 12 seconds left. There is your 4 points above the fair value gap, so you're still kind of close to the ideal entry zone. You could chase here half, or honestly, you could even chase here full if you really liked it, because again, there's about 10 seconds left. It's kind of just up to you and how you feel about the situation. So you'd enter long right there, and me dragging my P&L thing means I actually got in right there on the stream. And yeah, once you see this, you're pretty much safe. And then now, boom, the candle closes. So now you can see the ideal entry zone is at about 625, but the price closed all the way above at 636. So if you waited for the close, you would get a horrendous fill. Now your risk to reward isn't good. So that's why sometimes you just have to chase or the trade doesn't make sense. So yeah, now I'm in. My fill is 627. I don't remember if this was half size or full size, but just to kind of run you through this, if I was in with half size, the only way I would enter my second half is price pulled back, which we'll watch if it does. If it doesn't pull back and it goes straight to that TP up there, I would just let this be a half size trade, and then it should hit TP here. Boom, hits TP right there. So again, and I had to chase, or else I would not have been able to even get in, or the risk to reward would be much, much worse on this setup. So price hits TP right there. I think this even hits the second TP as well. Yeah, it even hits the second TP as well. So very, very important, guys, that you chase. This was a great example too, because the first wick actually didn't close, and I made a decision, to still get in there. So this is one of those guys where it's going to take a lot of experience, and hopefully, if you're in my premium in the Discord, hearing me talk about chasing live and kind of walking you through it, I think will help you as you get more experience and more reps. So, all right, here's another example right here. This looks like good momentum here. This looks like a V shape. Pretty much there is where I would chase at least half. Again, once I see that like spike momentum a couple points above my ideal entry, that's where I would look to chase half. There's 20 seconds left here, so I definitely think this would only be a half size trade. And again, me dragging my little P&L bot tool there tells me that I got in actually. So now I'm in the trade. This is a little risky because, the more time that is on the candle, the more risky it is for the chase. But I like the momentum enough, so I got in right there at 621. Now there's 5 seconds left, 4 seconds left, 3 seconds left, and boom. It already hits its TP. It's already at 20 points. So another example, if I didn't chase, I would have missed this trade. So yeah, that's another thing. Another thing I want to talk about actually that just went into my head. Price reversed off of this so well. Holy. Another thing that I want to talk about is when you chase, your TP can be larger. Okay, what does this mean? Right? So if I originally wanted to get in with 10 micros, okay, 10 micros for 20 points on NQ is $400, right? But if you only go half size, which is 5 micros for 20 points, is only $200, right? So what I'm trying to say is sometimes I will hold my position longer if I'm in half size because it just doesn't make sense, right? If I was going to trim half of my contracts at 20 points with full size, that would have been a $200 trim, okay? But if I only get in with 5 instead of 10, and then my first TP hits, and I wanted to trim half my contracts, this would only be $100 because I'm not in with the amount of contracts I expected. You understand? So sometimes if I am in with half size, I might adjust my TPs and I might just hold for longer TPs to kind of offset the fact that I have less contracts. So instead of trimming at 20 points with 10 micros, I might actually look for a 30 or 40 point trim if I'm in with 5 micros, just so it makes sense. So instead of trimming at 20 points, I would actually just go break even there, and then I would aim for a 30, 40, or maybe even 50 point trim, depending on where the chart is showing me. Because, if I'm only in with a couple micros, and if I were to trim here, like I would make $50, $60, it doesn't make sense to me. It really just doesn't make sense to me. I'd rather just hold the position and go for a bigger TP. So that's kind of another strategy that you can do, because, I'll chase sometimes on stream and there'll be people in the chat where they're like, I only made $70. And I'm like, there's your problem. you didn't hold for a big enough position, you trimmed too early. So that is another thing to talk about. So there we go, talking about that chase. We have two more examples here, and then we'll get out of here. So here's another example. Again, we got a nice liquidity sweep right here, as you can see by the red line. Now I'm waiting for this candle. There's about 10 seconds left, and I will show you where I would chase. So about right here is where I would chase. Again, very, very nice positive bullish momentum. There's only 6 seconds left on the candle, so I feel like it's very safe. I'd probably chase full here, to be honest, because again, there's only 6 seconds left. So yeah, I would chase full size, and then I'm just aiming for the higher fair value gap. And then again, you can see every single time I'm dragging that tool, so it shows that I'm in. And, you know, just by doing this, I'm making the trade just so much more efficient. I'm getting better fills by doing these calculated risks. So I think it's very, very important. So let's see how this trade plays out right here. So this one right here, it actually pulls back. So now this, you know, the other two trade examples that I showed you, there was no chance to get in if you didn't chase. But this one, it actually gave you an opportunity. So you could see, you know, if you miss the chase or if you're looking to add the other half of your size, this is where you would look to re-enter. Once price gets within a few points of your ideal entry zone on a pullback, that's where you could enter. So again, you see this red candle right here. You could even, you know, look to enter it right here if you didn't get in the first time, or if you're looking to add your second half, this is where you would look to add your second half. You know, it digs even deeper into this fair value gap, so that's very, very nice. Let me just fast forward a little bit. So, you know, this gave you a really, really good area to re-enter if you missed it. But as we saw in the other two trade examples, that's not going to happen every time. Sometimes it's only going to let you get in right there. Boom, TP hit. Another winning trade. But yeah, sometimes it's just going to go without you, and it's not even going to give you a chance. So last trade example of the video. 1 second. Okay. Last trade example of the video. And okay, there's about 20 seconds left right here. Did sweep a liquidity level. Again, you know, I would want to, let me go back a little bit. I would want to chase a little more aggressive on this setup because I just see how good the confluences are. Like on the right, you can see ES sweeps this blue line. Very, very good reaction to the liquidity sweep. Very, very good momentum. These last 3 bullish candles in NQ. So I have no problem chasing here with about 15 seconds left. I would chase right here. My nose is itchy, sorry. I would chase right here. There's 14 seconds left. And all the other confluences look really, really good. So I would chase right there. I would get in the trade. And again, very nice chase, because if you did that just a couple seconds later, it goes all the way very close to that TP. And that's why you can't hesitate with chasing. That's why this is the most complicated and hardest thing to grasp, in my opinion, in the entire model. It just takes experience, it takes conviction, and you can't hesitate, because if you hesitate just a couple seconds, that's the difference between you getting in the trade and winning and missing the trade. So yeah, that is another example. Hopefully, I can't believe this. Wow, I'm watching this in real time. We reversed right off that low. That's unbelievable. But hopefully you guys learned something. You know, chasing is, you're never going to perfect chasing. There's still times on stream. It is pretty rare at this point, but there are still times on stream where I chase and it goes against me. But it helps me way more than it goes against me. So, you know, that's why I do it. If you have any other questions regarding this, please message me on Discord, and we'll see you on the next one.
What is going on, guys? If you're watching this video, that means you made it to the end of the free course. First of all, I just want to thank you for making it this far. I know it can be overwhelming, you know, so make sure you're taking notes. You can even go back, watch specific videos multiple times, because let's face it, you're not going to get everything 100% all at once. But, you know, I hope that this free course can be a reference and a resource for all of the traders out there who are trying to learn ICT and IFVGs, where, you know, I can give you guys this link and you can go back a year from now and come back to these videos, because this is pretty much all of the last 2 to 3 to 4 years of trading put into 20 videos, and how I've gotten to this point and become profitable. So we're going to talk about a few things. One thing I will say is, again, at the end of this course, you might be feeling really overwhelmed, and I want you to give it a shot, man. I really, really do want you to give it a shot. I want you to give trading a shot. The fact of the matter is, so many people, they quit way too early. And I explained in my first video of the course that I think if I didn't have the situation I was in, I might have been one of those people. You know, I might have quit too early and never realized my full potential in this thing. Because people come into this just expecting quick results, and that's not the reality a lot of the time. You have to go through months and months of losing and lesson learning before you can actually see any money come into your pocket, and people aren't built for that. That's why everybody's not a day trader. I truly believe this is one of the best jobs in the world if you can do this. You know, I've already explained it in other videos, but the life it allows you to live is amazing. You know, the concept of money, it's sickening. You know, people work real jobs and they put in real hard work and real hours to make, I don't even, it depends on the country, obviously, but 1,000, 1,500, 2,000 a week in some countries is an amazing salary. And, you know, in trading, you can literally make that within a minute of pressing a button. Like, so it's crazy, you know, and that's why psychology is such a big thing in trading. You kind of lose grasp of that concept of money, because it's nuts. It's nuts, the potential that you can have. And again, I'm truly blessed and truly humble that I made it this far and that I didn't quit. And I'm simply just trying to help you guys. This course is completely free. I'm not sitting here charging thousands and thousands of dollars for this. I want you to take this information, go into the charts, put in the work, and try to carve a better future for yourself. You know, I truly mean that. And again, why can't you? Why can't it be you? You sit there and you see these people on social media, these successful entrepreneurs, these people who are making money online, they're traveling the world, they're affording these nice luxuries, you know, they're paying for their parents' retirement. Why can't that be you? They're no different than me or you. You're no different than me. I'm no different than you. I was in your exact shoes not too long ago. So the number one thing is you have to believe it's possible. You can't get discouraged the second one piece of adversity comes your way. And you just have to keep pushing, because trust me, like, the light is at the end of the tunnel. And I was never going to take no for an answer. You know, I always tell myself, I tried so many different strategies before trading worked. I went through all of them in the first video, but I was going to keep trying until something worked. You know, I was relentless. I would have tried 30, 40, 50, 60, 70 different strategies. I would have tried 30 million different alternations of those strategies. I would have tried every combination in the book before I quit, because that's how bad I wanted it. That's literally how bad I wanted this life and how I wanted to live. I wasn't just going to quit just because I lost a couple $1,000s. And that's the way I saw it, honestly. I'd rather sit there and try something really hard to better my future and create a life for myself that I would dream of, and risk losing a couple $1,000s in the process, than be content with my average life and go back to a 9-to-5 and make 500 a week or whatever it is. Like, that to me was worse than risking. And again, that's why I'm in the position I am today, and I'm very, very, very blessed. Very, very blessed. I want to sit here real quick and show you guys another example real quick. I'm not sure if I have shown you this before in the course. This is one of my mentorship students. His name is Safir. Safir had some trading experience coming in to my program, but it wasn't really with this strategy specifically. It was with other strategies. Safir joined my program in September, and I was just trying to, again, just like the free course, I was trying to teach him the strategy, teach him everything I know, how to do things correctly. and he joined at the start of the September. You can see this message here at the end of September. He was discouraged. He was really discouraged. He wanted a refund. He wanted to end the mentorship, and I at the time I denied him. I said, listen, I'm not going to refund you, especially this close. You've only given it, 2-3 weeks. I really want you to go through this mentorship. I really want you to give it your all. We can rediscuss, a couple months down the line, because I truly believe that what I teach works. And if you just put the effort and the work that needs to be done, you're going to see results. So you can take a second to read this message, and maybe, hopefully, some of you can relate to this message. Maybe some of you are in the exact position that Saphir might have been, just 6 months ago. And now we fast forward to just now, and Saphir has made over $30,000. This screenshot's about a month old, but Saphir has now made over $30,000 trading prop firms after joining my mentorship. And you can see the screenshot here. You can even join the Discord and talk to him yourself. I haven't paid him to say any of this in any way, shape, or form. But yeah, really, really cool stuff. Really, really, really cool stuff. I'm super proud of the guy. And this is just what's possible. This is literally what's possible. Within 6 months, you can go from spending a ton of money on a mentorship and wanting to quit, wanting to get out, to then transforming that into $30,000, and more importantly, unlocking the skill where you can now potentially do this for the rest of your life. So just don't quit is what I'm trying to say. Just don't quit. I'm also going to show you some other examples here. If we just swap over to my Discord, I can show these examples for days. You have one of my members, Speedy Bakes, here. He says he is up $30,000 this year alone, joining my streams and trading with me. This guy trades the same exact strategy that you have watched in the last 20 videos. Shout out to JC, who made $10,000 last month with a broker statement proof. We can keep on going. Shout out to Artada, who made his first $10,000 month. I can go on and on and on and on, and all I'm trying to show you, again, we have Day Trader, made $20,000 with Apex up until this year. That's only 3 months. I can go on and on, man. We have Eat More Chicken, who made a $30,000 payout. The point is, this stuff works, and whether it's going to work for you is completely up to you. How bad do you really want it? How much are you going to journal? How often are you going to show up? Are you going to put the work that needs to be done? And I hope you do. I hope you do. You watching this video, you really deserve to live the life that I live. It's amazing. It's truly amazing. I never have to worry about bills. I never have to worry about where my next meal is going to come from. I can buy whatever I want, and that's because I worked hard. So I really, really hope you can experience this in your life, and I'm rooting for you. From the bottom of my heart, I'm rooting for you. So thank you so much for watching my free course, guys. If you have any questions, feel free to reach me in the Discord. That is the best way to contact me. I respond to pretty much all messages. So I hope to see you in there. Best of luck in your trading journey. Peace out.